there's this growth conundrum with investors trying to figure out which is the most likely path from here.
It's almost like all data is bad data these days.
We need to see inflation peaking and coming down. We need several months of this.
Near term, we might easily be stuck a bit longer in a fat and flat range.
I'd say it's been brutal, and it's likely to remain brutal for a while.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a week, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive by about 1%. TK yesterday within a whisker of a bear market.
A bear market, and by the measurements there, the drawdown's there. We'll get the drawdown up in a moment. I mean, you look at the events yesterday and staggering to the weekend, John, and it's about just reaffirming where are we and where are the central banks. A great lineup this morning to give us perspective into the weekend.
Well on course for a sixth straight week of losses, Tom, on the S&P 500. Seeing a lot of notes out there on the south side asking one big question. Have we seen capitulation?
Well, I was watching it from the game. Tottenham, I thought, just did really well against Arsenal, John. And, I missed a lot of the movement yesterday. But the fact is, a bid today, but what's the confidence in the bid? The thing I would suggest has changed through the week, John, is the havens have clicked in a little bit. That was not true a week ago.
Bramo is super excited for the match review a little bit later this hour. Lisa, we'll stick to markets for now. Don't worry.
Thank you.
This market heading south. A big move yesterday. At one point within a whisker of a bear market. We didn't close there. Have we seen capitulation? Bramo, B of A saying that happens when you start to sell what you love.
And saying that perhaps we're not quite there because they talked about private equity, they talked about big tech, and we have seen a huge sell-off in big tech, but they're suggesting that perhaps it could go further. And then we did, though, see outflows out of cash. This, to me, was one of the biggest notable features because that is not necessarily out of a desire to deploy that into risk, but rather to pay for either margin calls or to offset other issues. And that was very interesting to me.
I thought for a moment you might be implying that a certain someone took a day off and there was outflows out of cash on that same week.
To bet on
we can touch
the tots.
On that, maybe.
You really want to touch on that?
Or to clean up this mess with Twitter. In the pre-market, we're down 25%. Elon Musk just moments ago, Lisa, putting this deal on ice.
Honestly, I don't know what to make of this because he was talking about how perhaps he was mistaken, that there are many fewer bots than he had previously thought as members of Twitter. How could he not have understood that in due diligence until now? How much does this violate certain types of laws? And then how much does he have to pay the breakup fee if he walks away from this? So many questions, but Tesla shares, on the other hand, are actually doing pretty well as people remove the potential for some sort of liability tied to Twitter.
Well, Tom, the numbers speak for themselves. Let's just look at the numbers. The deal price, the agreement's $54.20. In early trading, we trade at $33.90. That's quite a spread.
The guy plays by his own rule book. I mean, I have no idea how Gary Gensler fits into this. And I guess as someone involved in a transaction, he has every right to question what he has to question. But if you're a Twitter shareholder, your head has to be spinning. Imagine the employees, how they feel.
Well, I'm sure it's spinning a whole lot more if you're trying to run that company as well. Lisa, as we look a little bit further away from the news this morning, have we even got the financing lined up? I keep seeing those reports change from day to day, week to week.
Well, yesterday, the irony of this all, we had a news article out last night talking about how he had found a way to get a loan, Elon Musk, without necessarily pinning the Tesla shares up against it, to not necessarily face a margin call with Tesla shares. Seemed to be the opposite direction, moving closer to a deal. Now he sort of seems to put it on ice. Hard to understand the machinations here, both on the financing side as well as what he's actually going for with a potential ownership.
Fair to say, Lisa, based on the move we're seeing this morning, that Elon Musk is saying the deal is on ice, but the market's behaving like the deal is off.
I think that that's fair. Of course, if he says it's off, how much more downside is there given what the other big tech companies have done?
Down 24% in early trading. Not the overall market, though. Don't worry. If you're just tuning in, we look like this on the S&P 500. We have a little bit of a bounce, up 0.9%. On the NASDAQ 100, up by 1.6. For 4 straight days, Monday, Tuesday, Wednesday, Thursday, yields lower. Friday, yields just a little bit higher by 5 basis points, Lisa, to 289.49 on a US 10-year.
Yeah, although this has been the biggest weekly drop in the 10-year yield going back back to March of 2020. Just to give you a sense of the size and scope, it was the week of the growth scare. That does seem to be the takeaway. What I'm looking at today, 8:30 a.m., we get U.S. import and export prices. Last month, it came in at the fastest pace going back more than a decade. This, to me, is fascinating, this idea that we're now seeing import prices climb even with the strong dollar because of oil, because of gas. How much does that start to come down? How much do we start to get some of those pressures alleviated, especially as the U.S. imports more and more and more? 10 a.m., the University of Michigan Consumer Sentiment Survey. People have been watching this to gauge the trajectory of how consumers are feeling. Does it translate into them spending less, into action? We do have such a dynamic labor market. How much does that give people confidence versus the higher prices and the negative real incomes they are earning? And today, the latest Fed speak, there has been so much Fed speak this week, John. I mean, honestly, it has been just dramatic. One speaker after another, and Jay Powell coming out last night and basically reiterating 50 basis point rate hikes. The next few meetings seemed sufficient. Today, we hear from Neil Kashkari, a Minneapolis Fed president, particularly focusing on oil prices and how that features into inflation, and also Loretta Mester of the Cleveland Fed. She's going to be speaking at noon. How much do they reiterate this feeling that they are on a good path, John, especially as we get some hotter than expected prints of inflation?
Lisa, thank you. Fed Speak of the Week. I'm not going to make that a thing, don't worry. It came from President Mary Daly of the San Francisco Fed. She spoke to Bloomberg just yesterday, Tom. Take a listen to this. I expect financial conditions to tighten even more. I would like to see continued tightening of financial conditions. That would be consistent with bringing supply and demand back into balance. That's quite a quote for a market down this much, waiting for the Fed maybe to step back in or back off. That's not happening.
The best indicator in this, John, Michael Rosenberg and his team invented at Bloomberg the Bloomberg Financial Conditions Index, which I believe is 11 variables moved into a soup that measures the stresses in the system. And we are out exactly one standard deviation towards restriction on that measurement. So we're getting there quickly. We're getting to a tightening of financial conditions while the Fed yammers on.
Just to reiterate, we're not going to start Fed Speak of the Week, just in case anyone feels like
I think we should.
Stopping that. We're not.
I think that would be great. I think, honestly, I think I should start that just quietly.
Dean Carnett joins us now, founder and CEO of Macro Risk Advisors. Dean, seeing a ton of notes asking the same question. Are we there yet? Have we seen capitulation? Dean, are we there yet?
Well, we've got to be working our way closer to it. I think I've been getting a lot of questions this week about the VIX sitting here in the low 30s, with some arguing that the VIX should be higher still than it is now. And I would say that the VIX might be a little bit low relative to where it might be. We have 1 month realized volatility in the S&P at 30. That's extremely high. But to get the VIX into the 40s, which would really, throw into question that we haven't seen capitulation yet, you're going to need a couple of things. You're going to need these 3% moves to become something closer to 4% on a more consistent basis. And then you're going to really have to activate some of the tail risks that I would say, even as there's been so much damage to price, the true pricing of the tail, the real uncomfortable lower left outcomes are not necessarily being as contemplated. And I'd put two things in that category. One is, as of course we're all talking about, is rates, how high rates have to go in order to quell this inflation process. The challenge with inflation is that it's so misunderstood that the Fed may need to overshoot in terms of rates, and that, as everyone on the Fed is talking about, can hit financial conditions directly. That's just another way of saying stock prices have got to go lower and vol's got to go higher. And then the other thing I would just point to, just a risk here in the markets, is just the crypto space. When you have something that is heretofore viewed as a pegged asset and it becomes unpegged, I think that really brings a lot of skepticism and fear to light. And when fear dominates, behaviors can become really strange. I'd say I won't own it at any price. It reminds me of auction rate securities. So, John, I think we're close. I mean, there's been a lot of price damage, but there are still these tails that could be activated. It really comes down to sometimes price itself can make things worse.
Dean, have you seen capitulation?
I don't think so. I think one of the outcomes here that is sort of the least contemplated is that the market neither goes up a lot or down a lot. It could just be that we're in a very bad Sharpe ratio set of circumstances for a period of time. So you may not lose a lot, but you're certainly absorbing a tremendous amount of volatility for taking risk in the U.S. equity market. I was just looking at implied volatility for Apple, Amazon, for Microsoft, for Tesla. These are all above 40, and in some cases, in Tesla's case, it's at 70. You don't want the leadership of the market to have option prices that are so high. It just speaks to the amount of uncertainty on the path forward. So what I see potentially is a lot of chop. It's certainly some version of a tradable rally, which we might be getting closer to, but it's not a good Sharpe ratio outcome for the market. And it comes back to, you guys were talking about Tesla and Twitter, this very strange correlation between these two stocks right now. Well, another strange correlation is that between stock prices and bond prices, negatively correlated for the better part of 2 decades. The last 2 months, we're at positive 30 correlation between the S&P and TLT. That's a very tough backbone for your 60-40 portfolio. It's a risk accelerant instead of the combination de-risking your portfolio. It's actually adding to the risk.
Dean, can I just say congratulations on a call you made on this program about 12 months ago. I think we always remember the bad calls. Let's remember a good call. I remember you coming on at the end of the interview, you saying something like, inflation is transitory, is the new subprime is contained. And I remember sitting here and thinking, wow, that is a big call. Dean, do you see it becoming as bad? I don't know whether systemic risk would be this time around. I don't think many people believe there is any. Do you believe there is?
I think a lot of the bad has occurred. And what I saw there was simply no forecast on inflation. I think it was really to be humble about how little we know about inflation, but just to observe how decidedly financial market centric the Fed's policies were, and that we had basically an all-time high in both stock prices and bond prices at the same time. The underlying force was the Fed, and that you had deterioration in the bond market via inflation fundamentals that were fast moving against nominal bond yields. So that was the observation. I think we're pretty far through, I would say, the damage. The damage is done. The pricing of the yield curve reflects a Fed that is going to do a lot. The questions here, though, are, again, given how little we understand about inflation, is it set to be very, very high going forward? It's going to come down, but is it going to stay in the 3% and 4% range for a period of time? And is the Fed willing to fight that? Is the 2% target a real target? Because if it is, that is going to be a real problem for the equity market. To get from 3 to 2 could sacrifice a lot of risk, the risk asset dynamic.
That's going to be tough. Dean, wonderful to catch up with you, buddy, as always. Dean Kernet there of Macro Risk Advisors. There was an interview with Chairman Powell yesterday, and if you go through the transcript of it, the amount of times he talks about 2, Tom, not 3 or 4, 2% inflation, it just comes up repeatedly, almost every time he speaks.
This is the arch research contemplation, John, into the month of June. What's the new level? And the great fear out there is we run a victory lap getting back to 4% inflation. But for all of the institutions, not just the central bank, I would suggest 4% inflation is absolutely unacceptable.
Michael Hartnett over at Bank of America puts out a note every single Friday. It's called The Flow Show. And there's always a couple of lines in there that jump off the page to me. And Lisa, this is the one that jumped off the page to me this morning. Markets stop panicking when policymakers start panicking. But policy panic is inflation. And that's Wall Street negative.
Honestly, try to wrap your head around that. What do the policymakers actually end up doing at this moment? Right now, policymakers, if they panic, what do? They just go against the market even more.
Futures right now positive by about 1% on the S&P 500. On the NASDAQ 100, John, up by 1.5%.
John, take it out, please. I'm deleting spam accounts from my Twitter account.
Are you getting rid of the bot accounts? What are you doing? Blocking them?
They're embarrassing. Yeah, I'm
You're
blocking
them.
spam accounts.
The conversation continues. I can't wait for the next segment.
Yeah, thank you.
Earnings season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable. We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan's spot on.
Delta flying. Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
The bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst? Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Families are struggling to pay higher prices at the pump. Oil and gas companies are recording record profits, with 7 largest oil companies announcing buybacks that could total $41 billion this year alone. Again and again, we see gas prices rise, sometimes when the cost of oil drops, oil prices drop, and price gouging needs to be stopped.
Speaker Pelosi, just yesterday, when the politicians speak, they talk about price gouging, and when you speak to the experts in the oil market, Tom, they're talking about refining capacity. Two very different conversations, it seems, between the oil patch and the people who follow that closely in Washington, D.C.
It's going to be interesting to see, and particularly in the Sunday talk shows, Face the Nation on Bloomberg Radio in the afternoon. And John, this is going to be really interesting to see if the Democratic Party, their gouging us tone, if it really picks up resonance. I don't know. I remember this from decades ago, but I really wonder, John, how it's going to go.
I look at the polls. I don't think it's resonating right now. I mean, it might resonate with the base, but ultimately that's not going to be enough. JP Morgan saying buy the dips out just moments ago. Low spare capacity implies a risk premium of $30. The prospect of prices above $125 this year, $150 in 23.
I did some math on catharsis as Dean Kernett was on, John, and we are nowhere mathematically near catharsis. 3 standard deviations on VIX back to the great financial crisis is a 41-42 level on VIX. We're miles away, John, from the real sweat.
Futures this morning, Tom, up about 1% on the S&P.
Now, a 2-hour conversation. That's what they deserve. Emily Wilkins is in Washington, and Maria Tadeo is in, I can't pronounce it, Germany, Wiesenhaus. I hope I came close, Maria, for the G7 meeting. They are in search of unity. Are the Germans able to spell unity this weekend?
Yes, Weissenhaus. And Tom, it's a key point because we are seeing that the longer the war drags on, it becomes very difficult to maintain this unity. When you look at the question of oil, the G7 agreed almost a week ago that they will phase it out. Having said that, when you look at the Europeans, they're not able to get this deal through the finish line. So essentially, to strip away the jargon, you have the Italians, the French, the Germans today agreeing to something on paper that the EU cannot follow through. There's also, of course, the economic repercussions that will feed through into all of this. The European Union is going to be deeply affected by this, not as much perhaps as the United States is going to be there. So yes, on the political front, they do say it's about unity. We want to help Ukraine win the war. To me, was very striking, by the way, that they now say this is about winning. It's not the peace, it's victory for Ukraine. But nonetheless, we are seeing cracks.
This is right where I wanted to go, folks. I mean, the zeitgeist in America, Maria, is Ukraine is winning. The Kharkiv pullback and all that, you know better than I do. But really, the images of the bridges across that river taken out, almost like out of the movies. Why are they dilly-dallying around if Ukraine appears to have the upper hand, at least for now?
Well, what you see, Tom, is that the Ukrainians have incredible intel. We've talked about this before. A lot of this being fed by the United States. They fight lean, but they also fight smart. But if they want to win, they need the weapons, and they've made that clear. We'll do the fighting. It's very clear to us. Nobody's going to come to the rescue. NATO's not even an option for a country. But if we want to stay competitive, we need the weapons, and that is the problem for Ukraine. This is a country, Tom, that on a monthly basis is bleeding cash. They say they need, and this is hard cash now going forward, $5 to $7 billion to pay basic expenses, and of course the weapons they can't pay for them, so they need allies to supply them. But yes, in many ways this is a war now that is very complicated for the Russians. It's almost approaching the 80-day mark, and you're seeing, by the way, and this is interesting, that those threats yesterday from the Russians to Finland about joining NATO, well, a lot of officials today are telling me, well, they can't even win in Ukraine. Can you imagine a war on two fronts?
Well, meanwhile, to that exact point, Emily, how much discussion is there in Washington, D.C. about either supporting or distancing the U.S. from Finland and Sweden trying to join NATO, given how much that will increase the tensions over in Russia?
I mean, to a certain extent, I feel like the U.S. has become less cautious over time about not wanting to escalate tensions. We've seen officials begin to do things that perhaps at the beginning of the war they were a little more hesitant to do, just because they can see the trajectory that it's on. I mean, Tom's absolutely right. The zeitgeist here in the U.S., in Washington, D.C., is that Ukraine is going to be able to ultimately declare some victory in some way, shape, or form. Of course, to do that, they're going to need funding, and that's been the big pressure in Washington again this week, moving that $40 billion funding to Ukraine. You saw the House move in a very bipartisan manner earlier this week. The Senate wanted to get it done. You saw Mitch McConnell and Chuck Schumer actually together pushing for this bill to go through. But unfortunately in the Senate, if you want things to move fast, everyone needs to be on board. Senator Rand Paul from Kentucky blocked that quicker movement because of concerns about the prices here. So that bill still is going to be able to pass, but it's not going to be able to do so until mid next week. That gets you really close to that May 19th cutoff, at which point the White House is saying that they're not going to have additional funding reserves that they can send along to Ukraine. They're almost out of that money. They need it to move now. A lot of urgency here in D.C.
Emily, thank you. Down in D.C., Emily Wilkins alongside Maria Tadeo. If you're just tuning in, we have a bit of a bounce again on equities, up about 1% on the S&P 500. If you want a single name, one tweet moves the stock of Twitter by about 18%. That tweet comes from Elon Musk. The Twitter deal temporarily on hold pending details supporting calculation that spam fake accounts do indeed represent less than 5% of users. TK, we're at 37.12 and the agreed price is 54.20.
I mean, this story tires me, to be honest, John, but I will say, if this is a question now, why wasn't it a question 2 or 3 weeks ago? Because, you know, as a heavy Twitter user, I've lived spam accounts. I think it's delusional to think they're 5%, but what's the so what? This issue should have been brought up, John, weeks ago.
I would agree. I think many people would agree with you too, Tom. I think we've got to be careful not to get sort of wrapped up in the noise of this morning.
Exactly.
And focus on the stuff that matters. Do you have the financing lined up? Is there an agreed structure now? Something that Elon Musk has signed off on, Lisa, that means if he wants to, even if he gets through this issue, that he's ready to close this deal.
Yeah, and he's basically talked about $7.1 billion in other equity financing commitments from other investors, but that means he has to account for the rest, and he's concerned clearly about tying Tesla shares to any loan or financing agreement. There's also a larger issue here, John, which is the idea of one person tweeting one thing being able to so dramatically move the market cap of a $35 billion company. That, to me, brings a lot of attention to just the focus on this particular individual.
Hard to wrap your head around. The curse of Twitter is Twitter itself.
John,
it's kind of strange, isn't it?
Yes. It's simple. Tesla's cratered. That's all this is about.
Tom, that's a big feature of this.
Yeah.
For a lot of people, and Tesla this morning is heading the other way.
Yeah.
I would suggest for good reason. At 1% on the S&P, on the NASDAQ up by 1.6 from New York. This is Bloomberg. We are well on course for a 6th straight week of losses on the S&P 500, equaling the tally going all the way back to 2011. This morning, that bounce continues just a little bit, up 1%. Futures positive by 1.6% on the NASDAQ 100. We can talk about the tech pain a little bit later. Let's talk about the bond market moves right now. Your 10-year yield lower Monday through Thursday. 4 straight days of yields heading south. Topped out at 320 earlier in the week. Right now, 289.13. Yields just a little bit higher by 4 basis points. The FX team at Citi indicate that this one could actually go down back to 260, 250, those kind of levels. Again, we'll build on that through the program. I want to finish on this, though. Foreign exchange. Tom, we've been waiting. Euro dollar 103. Little bit of a bounce today, but think about these levels. 103.88. Was the low going back to late 2016. I think it was December 20th that year. Don't ask me why I remember this stuff. Euro dollar right now, 103.86. Once you take out that low, Tom, we're going all the way back to 2003.
I actually looked at that this morning, John, and I think the last couple of days have been eventful. The number one thing I'd say, John, is there's a little bit of a haven move in stronger Swiss versus that beleaguered euro. But to me, John, and this comes off Steph Flanders' interview with the Chancellor of the Exchequer, sterling flat on its back. I'm sorry, that can't help euro.
There's a reason I put these two currencies up together, Tom, because these are the countries, the Eurozone, not a country before you start writing in, I know, the UK, 2 central banks that are hiking into weakness. The Bank of England's already doing that. The ECB might have to as well, and that's why we're seeing some of that currency weakness too. That meeting, Tom, next month, June, for the ECB, a big deal.
Yeah, it's a big deal, and it's a complex political deal as well. I don't even want to pontificate on it, John, until we get much closer to it. It's a huge movable feast for Christine Lagarde.
Every move lower we see in that currency pair, though. More weakness, that becomes a bigger and bigger problem.
We are advantaged, folks, right now with Alex Webb. He's Bloomberg Quick Take reporter, but truly encyclopedic on the machinations, if you will, of all this technology. Alex Webb joins us here, and I guess on Twitter, but to me, Alex Webb, far more on Tesla. In my reading of Tesla, you mentioned Benzinga with a 700 number on a margin call on Tesla. Well, down we go. Maybe it's 500, maybe it's 700. But the answer with a 41% drawdown is Tesla's there. Is the announcement this morning, Alex, about Twitter, or is it about Mr. Musk and Tesla?
I mean, it could be any number of things. I think that, yeah, we've seen Tesla shares. They're closed at about 727, I think it was yesterday. If the 700 is the margin call point, they're clearly knocking on the door of that. We could also say that, well, maybe it's testing where the natural Twitter share price should be if it weren't for this bid. And it's cooled down 18%. It's in the 30s now. The offer price is $54.20. And then the final possibility is that Elon is just being sarcastic. He's going, sure, I'm going to put the bid on hold because of this data point, right? You know, that sarcasm doesn't come across very well in tweets. You might
Alex,
tweet again in 20 minutes saying, gotcha, haha.
We're asking you to work out what someone is thinking. I think that's impossible. So let's focus on the deal. Do we know whether the financing is actually lined up? The structure, all of it? Has Elon Musk signed off on anything to go forward and close this deal, even if he wants to?
Well, I mean, we don't know that all the financing is in place, and that's the key thing. And then, of course, investors are looking at that first piece of evidence. They're hearing what Elon says at a conference earlier this week, where he said, I don't know that I'm going to be able to complete this deal. And then you see where the share price landed at even before this tweet this morning. Last night it closed at $45. It's a huge spread to the $54.20 offer price. So there's a lot of skepticism already priced in. Investors are understandably skittish about the likelihood of this deal going through. So if there's any sign that it may not, it's reacting as the way we've seen it in the pre-market at the very least.
What's the penalty for Elon Musk if he does walk away?
Well, that is the one concession that the Twitter board was able to extract from him. They weren't able to secure a better price. They got $1 billion breakup fee. And so that, in Twitter terms, is meaningful denarii. That is like, they pay $3 to $4 billion in operating profit each year. $1 billion, if Elon's complaining about the spam bot problem, well, capital from a breakup fee could go a long way to fixing that, frankly. The odds are, that may not be dedicated to that, some might be returned to shareholders, but it is a big chunk of change for Twitter, if not for Elon himself.
Alex Webb, thank you, sir. I'd also suggest this, that a lot has changed in the last couple of weeks in this market, and that there has been a degree of stability in Twitter stock relative to other tech names. And we're finding out, perhaps, what this name is worth in this market. Now, Elon Musk wouldn't be the first person walking away from a deal. If he does, I'm not suggesting he will, but he wouldn't be the first off the back of a big market correction. Do you remember the LVMH Tiffany's deal? And then COVID happened, Lisa, then the lockdown happened. Wasn't that deal going into shutdown?
Yeah.
And ultimately, you saw what was happening with the market, and LVMH turned around and said, OK, I think maybe we need to rethink the price. I wonder how much of this is going on. And again, I stress, it's really difficult to talk about this because you're asking people to work out what someone's thinking. And that's a dangerous business.
It is a dangerous business. I think we can say, even when Elon Musk came out with his first proposal, that people thought that it was high, $54.20 for each share. And the fact that the board members just took it at first blush without looking for competing offers also sent a pretty strong message. So could he be having not buyer's remorse, but remorse for the bid in terms of how big it was, John? That's the thing.
Down 20%, Tom, in the pre-market. 36 is the price right now. The agreed deal, $54.20.
Continuing to follow that story this morning. Megan Green, now Global Chief Economist, Kroll Institute with us and Senior Fellow, Harvard Kennedy School. Megan, you know the framework here. 2% and under is where we're comfortable on inflation. Adam Posen at Peterson Institute has controversially suggested maybe the new 2% is 3%. Hope and a prayer we're trying to get back to 4%. How important is this discussion of 2, 3, and 4% is a new level of inflation?
actually don't think it's that important. Lots of people have been saying that the Fed should be targeting 3% inflation all along anyhow. The point isn't whether it's 2, 3, or 4. It's whether it's stable or not. And so I think the glide path to that is what's most important, whether it's 2, 3, or 4%. I think the Fed, by the way, would be fine with 3 or 4% inflation by the end of the year. Unfortunately, I don't think we'll quite get there yet. We might have to wait until next year for that. But it's the path there. As long as inflation expectations remain anchored, I think the Fed is okay with overshooting their target by that much. They're just not okay with what we have now.
How much of that glide path is linked to the glide path of a slowdown in economic growth?
They're clearly linked, and they get at the debate on whether inflation is so much higher because of demand-side factors or supply-side factors. And we economists just fundamentally cannot agree on that, in part because we've never put the economy on a deep freeze and defrosted it before, so we've never done this before. But also in part because it's demand relative to supply and supply relative to demand. So if we have a weaker economy, that undermines demand, and so that can take some of the heat off inflation. And that's pretty much all the Fed has got to work with. The Fed can't do much about supply-side actions, and I tend to actually think that it's the supply-side factors that are overwhelming demand-side factors on inflation right now. All the Fed can really do is engage in what we economists call, aggregate demand management, which means killing off demand. And that's why everyone's so worried about Fed actions resulting in a recession.
Megan, if you're talking about the majority of inflation coming from the supply side, then essentially, given how strong those pressures are, does the Fed essentially have to spur a recession in order to fight inflation? And I ask this because, frankly, it's the sort of delicate issue that a lot of Fed officials are trying to dance around.
Yeah, it may well have to. As I said before, the Fed can't do anything about supply-side factors. All it can do is tinker with demand. And so we obviously are out of whack between the two. And so the Fed's going to have to cool off demand. And of course, central banking tools aren't precise. They kick in with long and variable lags. And so, the Fed can't tweak this perfectly. It may end up hiking too much and pushing us into recession. In fact, that's what usually happens. The hope is that the Fed can generate some kind of soft landing.
Yeah.
I would say this is going to be really hard. I mean, the Fed is effectively trying to thread a needle wearing oven mitts blindfolded. It's going to be really tough.
So we haven't really seen the repricing to the same degree in credit as we have in equities. And this is interesting because, frankly, a lot of people look at credit as the canary in the coal mine. It has not been that. How concerned are you about some sort of crisis to be in terms of the next couple of months or even a year, because you're getting both the growth slowdown and rates that are higher?
I'm not that worried about it. Before the pandemic hit, I was very worried about corporate leverage in the U.S. And of course, the Fed's actions in response to the pandemic supercharged corporate leverage. That being said, companies have built up huge cash positions. And so I think that they've got a while to burn through that before we really need to worry about credit and about kind of defaults that end up being sort of cascading defaults, prompting a recession. I think we're a long way off from that. So I'm not particularly concerned. For what it's worth, though, I think if that were to happen, if there were signs that was coming, I think the Fed would actually about face. And there the Fed put still exists, I think. The Fed is fine watching equity markets fall for now. That's not really systemic. If we saw dislocations in the credit markets, that would get the Fed's attention.
Megan Green of the Kroll Institute. Megan, thank you. I wrote that line down. The Fed is trying to thread a needle, Lisa, wearing oven mitts, blindfolded. That's difficulty.
It sounds like my kids trying to cook, honestly, and that's the issue that we're seeing in markets.
A mess.
Yes, that's one way of putting it.
All of the above. Kit Jukes this morning said this on inflation. I think this is a really important point. The driver of inflation has switched from supply chain issues, Tom, or even the surge in post-pandemic demand to the tightness of the labour market that can only be solved by weaker labour market data and so weaker growth. Kit Jukes of SocGen a little bit earlier this morning.
Yeah, I agree with that. And I started percolating what, John, 2, 3, 4 weeks ago as well on the labor market. I really haven't seen a markdown in the labor market yet. Maybe that awaits the weekend research notes.
Have you ever had TK's cooking? Lisa?
Yes, I have. He's actually a really good chef.
Can I just say he's actually not bad?
Yeah, he's really good.
It's pretty decent.
I like
stuff.
how I say it's really good and you say not bad.
No, people might be surprised. That's all.
Guys, with a Swanson TV dinner, that differential between $350
Is that what you gave me?
and $375.
Is that what you gave me?
Yeah, I do the Swanson TV dinner and take it out of the aluminum.
Yeah.
6 basis points. Call it 5 basis points.
Lisa,
now
he
on a
doesn't
10
know
year.
what a Swanson TV dinner is.
$289.49. We've talked about that a million times on Bloomberg Radio. Do we have to do
I
that
have no
segment
recollection.
again?
Evidently we do.
Futures up 1.1 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the First Word News, I'm Laura Wright. Elon Musk's proposed $44 billion takeover of Twitter is now temporarily on hold. Musk announced the delay in a tweet today. He's waiting for details supporting the calculation that spam and fake accounts make up less than 5% of Twitter's users. Some European Union nations say it may be time to consider delaying a push to ban Russian oil. The problem is they can't persuade Hungary to back the embargo. By putting the oil ban on hold, the EU could proceed with the rest of a proposed sanctions package. The UK's Chancellor of the Exchequer, Rishi Sunak, says the Brexit settlement in Northern Ireland is causing economic and political harm. On Bloomberg Television, Sunak was asked whether the UK would take action on its own.
No decision has been taken. Our preference has always been to have a negotiated settlement. I know the Foreign Secretary continues to engage with her counterparts in Europe about how we can find resolution to some of the very real challenges that the protocol is causing.
The comments are likely to be seen as an attempt to publicly align himself with Prime Minister Boris Johnson after reports of a rift between the pair. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
We know we're not in the 90s anymore. I think we're dealing with much higher inflation volatility, a very different uncertainty on monetary policy, and even the growth picture, I think, has certain uncertainties.
It's been a really tough week in this market. That was Christian Muller-Glissman, the Managing Director for Portfolio Strategy at Goldman Sachs. I think we asked him whether this was a bubble bursting, and he said it was a valuation re-rating. OK. Futures on the S&P up 1%, on the Nasdaq 100 up by 1.7. Euro-dollar, the smallest of bounces, 103.82. We're talking about levels we haven't seen in about 20 years, Tom, on euro-dollar.
I just had to take a sip of Tang, John. I was just thinking of VetBill's Ethereum account, which is at a valuation readjustment as well. The euro, John, what do you think here? I mean, what's the key level? Is it parity? I think it's before parity.
Look, it was 103.88, Tom. That was the previous level, the previous low back in late 2016. We went through it yesterday.
Yeah.
Next step is the ECB and how President Lagarde guides us through the rest of this year and how much tightening they can actually deliver given what we're expecting to see happen to the economy.
Let's get to it. Stephen Englander with us, truly one of the best in the world on what are called cross rates. He's with the Standard Chartered Bank. Stephen, we've got a bunch of things to talk about. Let me cut to the haven dynamic right now. If I look at safe havens in the last 2 days, picking up a little bit of spark with stronger Swiss franc against euro, what do the tea leaves of the safe havens indicate?
Well, I think you want to be careful about which safe haven you choose. Day in and day out, the dollar's been by far the most reliable safe haven. So, you get Swissy and yen working when the risk-off shock takes the rates down. So when the world's concerned that the economies are falling apart and activity is slowing, yields come off, then they come into the picture. But when the fear is what central banks are going to do to get inflation down, they've been pretty worthless.
Steve, your stance
the one
this year, and I want to build on this, and I think this is the important place to start. You came into this quarter in a position where I think others really weren't. You don't believe the Fed can take it as far as other people think. You expect the front loading to some degree, but you don't think after that we go much further. Can you take the data of this week and tell me why there's space for modest comfort looking at that and why you still believe that's the way forward from here for this Fed, because it's quite a unique perspective compared to where the rest of the street is at.
Well, you got to take a deep breath. If inflation for all goods and services is going up the same amount, say like the headline or core, 0.6, then there's no place to hide. When you get a number like we got this week, and it's concentrated in new cars, and we know that kind of those are stretched already, and we understand the supply chains, and it's not going to get fixed immediately, but it will get fixed when it's airfares, which are pushed by oil and by reopening, hotels, same sort of issue. You kind of say, okay, is that typical of everything, or is that isolated and everything else is more moderate? And if you take those components out, what you see is there's, not to exaggerate, that there's a slow drift downwards. Too slow for the Fed, by the way, right now to change their tone. But there is an indication that the center of gravity is beginning to shift slightly lower.
So, Steve, we look at what's going on with the ECB, and they're damned if they do, damned if they don't when it comes to the euro. If they hike rates, people probably expect the euro to weaken because it means slower growth. If they don't hike rates, that means that they're not becoming hawkish enough to address the inflation. Is there the same dynamic in the opposite direction for the Federal Reserve and the U.S. dollar, that basically if the Fed does back away, as you expect, that will be dollar positive for more dollar strength, simply because that will mean that there can be a more prolonged and easier downturn? A more prolonged recovery and an easier downturn, I should specify.
Well, I think all the stuff that we like about asset markets, equities going up, and commodity prices firm, and that's all correlated with risk appetite. But dollar weaknesses as well. I think I wouldn't want to bet that the euro dollar would stay at 103 if the Fed sort of said, look, Steve Englander is right, and we're not going to go as far as you think. Real interest rates have made a big difference. I mean, the ECB has to step up to the plate as well. But I think that if we're right, we'll see a dollar weakness as the market backs away from some of the more hawkish pricing that we still see in rates markets. They haven't really backed off.
So what happens if they say, actually, Steve, we don't agree with you, and we're going to keep going, especially considering the fact that we see inflation continuing to be pretty hot? Then what happens with the dollar? Then do we see parity? Do we see even lower, or weaker, rather, for the euro?
Well, yeah, that's when we start talking seriously about parity. If they were to say that, like the two kind of strongest indicators for positive towards the dollar is real interest rates going up and sort of equity markets, asset markets being under pressure. Now, the only offset would be is that the ECB has been pretty passive till now, kind of almost deliberately, sending out ambiguous signals about what their intentions are. Were they to say, look, we're the ECB, we target inflation, we're going to do what it takes, I think that would be enough, even though it would be painful. I think that they would regain some credibility in FX markets.
Stephen Englander, where is the big figure trade right now? There's so much going on, so much vol out there. Where's the pair where I can actually make some money?
Well, look, I that's very hard to say. I think that there's no sign yet that we're, at the bottom in terms of sentiment, so we could still go lower. But if you ask me what's most mispriced right now, I'd say currencies like Aussie and CAD, given where their economies are doing fine, and their real interest rates have matched that of the U.S. Terms of trade are great. If VIX were to settle down, it's just over 30 now, were it to come back into a more normal range, those guys would pop, we think.
Steve, awesome to catch up, buddy. As always, great work this week. I've enjoyed the read. Steve Englander there of Standard Chartered, euro dollar 103.82. Gina Martin Adams of Bloomberg Intelligence just out on a really, really nice set of stats. Just 39% of the S&P is down 20% plus since the market peaked versus 50% in the last three major sell-offs. Think back to 2011, 15 and 2018 as well. Energy, financial, staples, industrials are all holding up much better than usual. The problem with this market, Tom, is that good news or bad news? Good news that we've seen a bit of resiliency there, or bad news that we haven't seen the whole market correct just yet.
And what investors hate, and frankly financial media hates, John, is the in-betweeny, and maybe that's where we are on this Friday. I'm going to go back to Dean Kernet and say 3 standard deviation VIX, as Englander just alluded to, is way out. It's a 41, a 42, and someone can argue plus or minus a couple points. We are nowhere near catharsis by any measurement I see on the Bloomberg.
Problem is, at the index level, Lisa, where we have seen the correction of some of the big names that make up the index, hence why we're down almost 20%.
And if you take that and build on it, John Authors of Bloomberg Opinion put out a piece talking about how a lot of the biggest losers have been the havens, right? And this actually undermines a lot of faith when you think that something is actually pretty safe and a good store of value, and all of a sudden it's not. That's where the crises occur. At what point does that have a trickle-out effect?
That is not new. It is always the way.
Exactly.
Think back to housing, think back to government debt and the European debt crisis. The biggest risk is where people believe there is the most safety.
Exactly.
Futures up by 1.1% on the S&P. Yields higher by 5 basis points on a 10-year, 289.49. We're almost there. One more trading day to go to the weekend. This is Bloomberg.
There's this growth conundrum with investors trying to figure out which is the most likely path from here.
It's almost like all data is bad data these days.
We need to see inflation peaking and coming down. We need several months of this.
Near term, we might easily be stuck a bit longer in a fat and flat range.
I say it's been brutal, and it's likely to remain brutal for a while.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It has been absolutely brutal. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive by more than 1% on the S&P. TK well on course for a 6th straight week of losses.
Churning week and the losses are there. Yeah, there's a bid right now, John, but I'm going to call it a fragile bid, and I focus on the VIX. It's still above 30, 30.66. It's a bounce, but it's just a bounce.
Have we seen the worst of it? Have we seen the capitulation? We've heard so many people try and answer that question, Tom, over the last few days.
It just gets me going. It got me going yesterday coming back from Tottenham Arsenal. It's the same thing, John. I can't say it enough. You can measure catharsis. We're nowhere near there. I measure it well out above 35 on VIX into the 41, 42 level. We're miles away.
You are desperate to get that match review in, aren't you?
No, I don't want to do it here. I think it's completely inappropriate.
And I would agree.
The Musk news and the Twitter news is pushed Tottenham Arsenal aside. But I mean, I don't want to get into it now, John. But I just think it was, to see it was to believe it. I mean,
I'm happy we're on the same page for now. Totally inappropriate.
Totally
Twitter,
inappropriate.
Down 15 or 16%, Lisa, in early trading.
Basically, Elon Musk, with one tweet, wiping off billions upon billions of market value for this company that started the end of the day yesterday at $36 billion in value. How much does he really back away from this because of a concern about bots that seem to have been remedied because there weren't as many bots as he expected on the platform? And how much, to your point, John, is this basically a re-rating because he feels like he was going to get a bad deal and going to pay way too much for a company that should have priced way lower if it hadn't been for his influence over the past few months?
The extra point as well is the financing lined up.
Well, yeah.
Perhaps those concerns about bots are justified. We'll see. Right now, there is a massive spread between where the stock is, Tom, 38, and where the agreement is, 54.20. 54.20 versus 38.
As we talked to our Alec Webb, John, I think it's much more about Tesla. I'm sorry. The drawdown on Tesla from the peak is 41%. We're down in the 700 level, which is where a lot of people calculate the margin call. Maybe the margin call is below that. But Mr. Musk has to be looking at his core holding as a foundation to his analysis forward.
Big move, and to that point, Tom, Tesla up by more than 5% this morning. From New York this morning, good morning. Let's whip through this Friday morning price action for you. We are positive across the board here on the S&P. On the NASDAQ, the S&P up by more than 1%. The NASDAQ 100 up by 1.6. Yields are higher by 5 basis points to 289.85. And this takes some getting used to. A 103 handle on euro dollar. 103.88. Back to the lows of 2016, Lisa. Positive about 0.1% today.
Yeah, and just to put that into perspective, as you've been noting this morning, those 2016 lows were just a hair away from necessarily getting back to 2003, 2002, and just a complete sea change in the euro experiment in the modern world. 8:30 a.m. is the beginning of a slew of U.S. data, U.S. import and export price information. How much do we see a decline from some of the highest levels ever in history the previous months, because we are seeing oil prices come down? How much does that matter? We just saw gasoline prices, at least in the futures market, reach a new all-time high, because as we've talked about on this show, it is a refinery problem, not necessarily just the price of oil. And we have seen refinement shortages unlike anything in recent history. At 10 a.m., we get University of Michigan consumer sentiment. Do we see an improvement in sentiment or a worsening as inflation continues to grind higher and as people start to worry that perhaps the Fed cannot get away with reducing inflation without spurring or at least exacerbating some sort of recession? It's not clear whether they'd be spurring it, but they might be trying to get ahead of it before inflation has a more trenchant and more pernicious effect on markets and on the economy. And today we get a slew of Fed speakers, including Minneapolis Fed President Neil Kashkari. He speaks at 11 a.m. He's going to be focusing on oil prices and the ramifications for inflation longer term. And Cleveland Fed President Loretta Mester will also be speaking along with fellow central bankers from around the world to really give a sense of how to move away from such liquidity without spurring some sort of crisis.
It's what they're not saying that matters this week. They're not bothered by the prices on the screen going down, Lisa. This is different to what we experienced in the last 10 years.
They don't have another transmission mechanism. And this is the uncomfortable truth. If they are relying on markets to transmit financial policy, monetary policy, then they're going to have markets go down. And the question is, have they gone down enough to really bring down inflation just yet? And that is the tension right now underpinning volatility that a lot of people expect to continue.
The number one question for investors right now is a question that children on road trips have been asking for decades. Are we nearly there yet? Are we there yet? Anastasia Amoroso, Chief Investment Strategist at iCapital, joins us right now. Anastasia, let's ask that question. Are we there yet? Have we seen the worst of it?
Well, good morning, John. I think this is a great question to ask on this Friday morning after we've had a massive pullback this week. And I think what's happening is this morning we're assessing the damage that has been done and the value that has been created. So here's a few things that catch my attention this morning. First of all, if you look at the multiple on the S&P 500 or the NASDAQ 100, you're back to finally pre-COVID levels of the fall of 2019. So 16 and a half times multiple on the S&P 500. We were lingering around 19 or 20 times, which arguably was not fair for the current market conditions that we have. And perhaps this multiple that we have today is just a lot more justified. We've also seen, for example, quite a bit of capitulations from the hedge fund community. This week in particular, we saw the largest 5-day degrossing for some of the long short funds. So perhaps we have seen some of those flush out already. And then finally, we finally hit the technically oversold indicator of 30 or below it, relative strength on the S&P 500. So you put all those all those three things together, and perhaps you can make the case we're finally starting to trade around some sort of fair value justified for these market conditions. You know, the last quick point I'll make on this, Tom, if I can, sure. 16 and a half times, $235 of next 12-month earnings, that's roughly where we are today, 3,900 on the S&P 500. So I hope we can stabilize around these levels, but I certainly wouldn't count on us getting back to all-time highs.
So, Anastasia, what are you buying right now, given the fact that you do see some sort of washout?
Yeah, there's a number of things that I think are on our radar right now. Of course, I have been talking about technology stocks, and I'm going to continue to talk about some of those beaten up semiconductor and software companies. And the key here is really to focus on quality earners that are growing those earnings at 15+% or more. And they have seen their valuations reset quite significantly. So, Lisa, the question is, do you buy them outright, or do you use the options market to give yourself a little bit better risk adjusted potential, for example? And so I like selling the puts on some of those stocks, monetizing what is really extremely rich volatility in some of those stocks. And that's a better way to position, in our view, than just going long outright for some of those stocks. I'll also say, take a look at the fixed income markets, right? If you look at the short duration treasuries, and actually short duration munis in particular, 3-year muni now gives you a yield of close to 4% on taxable equivalent adjusted basis for a 3-year duration, which is not a whole lot of duration risk to take on. So I do quite like that. And then, of course, there's a number of things we're doing in private markets. Private credit continues to be a top idea. And by the way, that's very insulated from some of the dislocations and lack of liquidity things that we have play out in some of the public markets.
Some people would say the reason why those areas haven't sold off is because they don't trade, right? That we haven't seen the price action, the price discovery in the same way that we've seen in some of the other names. And we've been focusing on big tech. The safe havens have been the ones that have seen the most pain. How concerning is that to you? I mean, is this basically people selling what they can, not necessarily what they want, and that if things do get worse, they will go to some of these other areas?
Well, if the economy continues to slow down and does tip into a recession, this, of course, the private markets are not going to be immune from that. For example, you take private credit, for example, and default rates on that will track high yield, will track leverage loans. So you will certainly see some reset in valuations there. The same story for private equity and venture capital. We have seen those valuations be more resilient, but I do suspect the longer this turmoil goes on in the public markets, the more it spills over into the private markets as well. However, if you look at private credit, for example, and if you compare how that's traded throughout 2008 to throughout 2018, the drawdowns were not nearly as severe as they were for high yield and leveraged loans. And the reason for that is you're not a forced seller into an illiquid market where the dealer inventories have been significantly lowered and the dealers are just not willing to take on that risk. So I do think that private markets are certainly not immune, but they're not going to be exposed to the same technically driven dislocations.
Anastasia, an important conversation as always. Thanks for joining us. Anastasia Amoroso there of iCapital, with equity futures up by 1.1% on the S&P, on the Nasdaq up by 1.7%. NATO likes to have an open door policy. It doesn't mean that walking through that door is easy. Here's a headline from the Turkish leader. Tom, Turkey does not favour Sweden or Finland entering NATO and getting membership.
These are complexities, to say the least, and sprawling from the Bosphorus and the bottom of the Black Sea way, way up north. It's a continuum of that huge border with Russia. And John, nobody has a border with Russia like Finland. We've got to remember that. Finland is absolutely unique. And of course, there's a whole deep history here as well, but it really speaks to the complexities Mr. Erdogan faces.
Tom, you've talked a lot about Turkey's role in the invasion in Ukraine, the tension between Ukraine and Russia, and whether Turkey could broker some kind of peace. Not necessarily the direct role in that, I'm not implying that. And also their role in NATO and what this could mean for additional membership going forward. It's always been the problem for me, Tom. They talk a lot about Ukraine becoming a member of NATO. It's tremendously difficult to walk through that open door and get over that threshold.
It is. And the trap we all have, John, is we all read our books on this and we want to be romantic and look back centuries. This is about the here and now in the forward. And the answer is Russia will respond to Finland NATO. It's just how will they respond?
Futures right now on the S&P up by a little more than 1%, on the Nasdaq 100 up by 1.7%. Yields are higher by 5 basis points, 290 on a 10-year. Jim Paulson up in the next hour. Looking forward to catching up with the man from Luthold Group from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Laura Wright. Elon Musk's proposed $44 billion takeover of Twitter is now temporarily on hold. Musk announced the delay in a tweet today. It has to do with the details supporting the calculation that spam and fake accounts make up less than 5% of Twitter's users. The Senate was forced to postpone a final passage of a $40 billion Ukraine aid package after Republican Senator Rand Paul refused to allow the vote. Paul is demanding that lawmakers add a provision to appoint an official with oversight powers for the aid. The Senate is now expected to vote on the matter next week. Federal Reserve Chair Jerome Powell has reaffirmed his plan for raising interest rates to fight inflation. In an interview with the Marketplace radio program, Powell said the central bank is likely to raise rates by a 0.5 percentage point each of the next 2 meetings. He pushed back on speculation the Fed's considering a 75 basis point move. For the first time, Chinese officials have set a timeline for ending one of the longest and most punishing lockdowns during the pandemic. Shanghai says it plans to stamp out the community spread of the coronavirus and start opening up the city by May the 20th. The lockdown has been in place almost 6 weeks. Shares of Robinhood are soaring in pre-market trading. Cryptocurrency billionaire Sam Bankman-Fried has taken a 7.6% stake in the troubled online brokerage. Robinhood shares have plunged 77% since its IPO last summer. There's concern that the retail trading phenomenon is losing steam. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
I think valuations have come in quite a lot, and that I think will help people start to look for opportunities where they can be repositioned for a longer-term appreciation. It may still be rocky for a while, but boy, some of those valuations have gotten very attractive.
Joanne Feeney there, the partner portfolio manager at Advisors Capital Management from New York this morning. Good morning. Futures positive on the S&P, up by 1%. On the Nasdaq 100, positive too by 1.7%. In the bond market, yields aren't lower this time. They have been through every single day this week so far. 320 the high of the week, 289.67 right now, up by 4 or 5 basis points. One tweet takes Twitter down by 15.5%. We trade in the pre-market at 38. The agreed price with Elon Musk was 54.20. That tweet came from Elon Musk a little bit earlier this morning. Tom, it read, Twitter deal temporarily on hold, pending details supporting calculation that spam fake accounts do indeed represent less than 5% of users.
It's ebbed and flowed over the years, John. I remember when I first jumped on Twitter years ago that there was huge amount of spam from, of all places, Australia. And then that went away. And there's waves of it here, waves of it there. We all know it's there. What's the amount? I guess we'll find out. Mandeep Singh knows more about this than we do, senior technology analyst at Bloomberg Intelligence. Mandeep, do you have any idea how large the spam is at Twitter, or for that matter, at Instagram?
Well, so look, he's saying 5% of the users are spam, and it doesn't surprise me because in the case of Twitter, we know, they have had a problem with fake accounts over the years, not so much with Meta or with Snapchat. So I do think it's a Twitter-specific problem. And look, I think this company should be valued, the EV should be valued based on a per-user basis. So if the user base goes down, then I can see him negotiating based on that to bring the price lower.
You want to bring the price lower, and I would assume it has to do with the margin call as well. How much of this is linked to the price of Tesla on a drawdown of 41%?
Yeah, so clearly margin call linked to Tesla stock was a risky bet to begin with, and he tried to bring it down with more private investors. And in this case, I do think he'll be able to negotiate the deal lower by another 6 to 8 billion, and that will take away the margin loan completely. So that's how I think he's approaching this.
Are we at fair value right now, Mandeep? Can we look at what we're seeing right now in markets and say that's probably the more appropriate price target?
Yes, so the market is telling us that Snapchat is currently around 37 billion valuation, and Snapchat is a higher growing asset than Twitter. So why is Elon paying 44 billion when Snapchat is around 37? I think explains the delta. And also, look, I mean, this is a market where valuations for internet companies are about 5 to 6 times sales. And clearly, there is a premium multiple attached to the Twitter deal, so there is scope to bring the multiple lower here.
Mandeep, what's the precedent here of someone coming out, offering to buy a company for a certain price, then backing away very publicly to see what the market does, and then use that to renegotiate a lower price?
So I think if you look at the clause, he did waive out the diligence clause, but then there is a breakup clause of 1 billion. So there isn't a precedent for a deal like this. It's unique in a lot of ways. You know, you have a billionaire founder going for such a big deal. Look, I do think, it's unique in the sense that this is a function of where the markets currently are. We weren't here 6 months back, but right now the valuations are just way lower, and there is no reason for him to pay 7 times sales when everything else is 5 to 6 times sales.
Mandeep, when you hear the list of people lining up, including Mr. Ellison, to assist Mr. Musk, how does a grizzled pro like you react to those names, the quality of those names?
I think it's great for him to have, private equity as well as, guys like Allison and probably, like Andreessen Horowitz. It's great to turn around the company because, look, this is a bet on turning around the execution, and he can't do it by himself. Although I do think, anybody who joins Elon is wary of the fact that, Elon has his own views on everything. And so he may not listen to everything they have to say. So there is that balance over there.
What about from a regulatory standpoint? A lot of people had baked in a high degree of uncertainty even before the Twitter controversy of Elon Musk. How much are we really looking at regulators that aren't necessarily going to sign off on this, not only in the U.S., but also Europe, which has come out and basically pushed back a little bit more?
Well, so the antitrust risk is low in the sense that, look, Tesla and Twitter are very different companies. So it's not as if, he's acquiring any market share here. And I do think, other than the fact that he didn't disclose his stake early enough, there isn't much of a regulatory risk here.
Mandeep, wonderful to catch up with you. What a story. It's not over just yet. Mandeep Singh, thank you. Dan Ives of Wedbush just tweeting the following. The implications of this Musk tweet will send the Twitter circus show into a Friday the 13th horror show, as now the street will view this deal as 1, likely falling apart, 2, Musk negotiating for a lower price, or 3, Musk simply walking away, Tom, with a $1 billion breakup fee.
Oh, the breakup fee's chump change. I mean, I know people are going to make a big deal about it, John, but in the scope of things, it's nothing here. I think, he, like a lot of other people, have been overcome by events. John, if you're in the triple leveraged all cash fund, you're not overcome by events. Mr. Musk is not in the triple leveraged all cash fund.
You can maybe make an offer, Tom. You've been thinking about that, have you?
Well, I've thought about it,
Chump change.
Chump change, just $1 billion to walk away. I'm with you, Tom. I know what you're talking about.
No, I'm sorry. He's worth $126 billion.
I know what you're talking about.
It's like what Harry King can walk away from the tots after they make the four.
Do you remember what Goldman's price target was on Twitter before they had to close their coverage because they're advising on the deal? It was 30.
Yeah, there you go.
They had a sal, and the price target was 30. And in the pre-market, where are we? We're in the 30s, aren't we? We're about 38.70.
John, seriously, and folks, off camera, Twitter pros are heated that he's overpaying for this.
This is what people felt at the time, Lisa. There were a group of analysts that believed that this stock was heading south. They had a sell, and they had a price target in the 30s.
And they thought that perhaps Elon Musk could bring some sort of his brilliance to the company, and they thought that he could bring it forward, and they thought he could actually get it done. But there's always been a huge margin of skepticism baked into the market, and it's just gotten super wide at this point. Does he even intend on buying it, or was there some sort of other motivation? I mean, these are all some of the questions as he looks to get financing and seems to be approaching this with a less calculated view than some would expect.
We've said this a few times this morning. It's a dangerous business to try and work out what people are thinking. I'd ask this, what if he's right? What if he's right and that number of bots it's really high? Where does it leave this company then if there's no deal and it's out there that a lot of the user base is just bots?
South of 30. That's probably what some people think.
Some finance journalists speaking to each other about where markets are. Futures on the S&P up by 1%.
You're trolling us. He's trolling ourselves.
The stat of the morning comes from Gina Martin Adams of Bloomberg Intelligence. 39% of the S&P 500 is down 20% plus since this market peaked. That number was 50% plus of the S&P 500 when the market made a big move in 2011, 15, 18. To Gina's point, she thinks there's part of this market that are holding up pretty well, considering. I'm sure it's not felt that way for many of you. Futures right now up 1.1% on the S&P. We're heading for a 6th straight week of losses, equaling the longest weekly losing streak going all the way back to 2011. On the Nasdaq, we're positive about 1.66%. You know the story in the bond market? Let's talk about it. 2s, 10s and 30s. Your 10-year yield lower Monday, Tuesday, Wednesday, Thursday. Topped at 320 on Monday. Pulled lower since then to 290.58. Yields just a little bit higher today by 5 or 6 basis points. But TK, that's been the story. This market's been transformed. We've moved away from the rate shock, the inflation shock, and really started to get our hands around a growth shock.
Well, it may be a growth shock, and that's the last 3 or 4 days, but I'm going to say they're intertwined, John, here at Ford, and I'm going to go back to, you've heard it too many times from me, John, we're wicked data dependent, and that's what's going to matter next week.
For the Fed speakers, Lisa, we're listening for something that they're not saying. They're not worried about this right now. They're not worried about the moves in the equity market. At least they're not telling us they are. And in the words of Bank of America, we will start panicking when policymakers start to panic, we'll stop. I think that's really interesting. Markets stop panicking when policymakers start to panic. The problem is policymakers are panicking about inflation. And Lisa, we're not going to address that anytime soon.
Basically, right now, this is exactly, arguably, what the Fed wants to see, a readjustment in financial markets. As Megan Green said, and I think this is important, until we see that panic in credit markets, companies not able to raise money, that aspect of financing, we're not going to see the Fed put come into play, and that's a long ways off.
Did you notice that we started to see a bit more of that just yesterday?
We started to see spreads widen out. We started to see a lot of money, the fourth biggest outflow ever from investment-grade corporate debt over the past week in the United States. How much is this the beginning, and how much is this just frankly a nod to what's going on in equity markets, given the fact that a lot of these companies have absolute fortress balance sheets right now still?
We'll catch up with Mike Schumacher of Wells in just a moment. We've done stocks, equities, we've done bonds. Let's finish on foreign exchange. Euro dollar and cable, and I'll finish on euro dollar. Just above that 103.88, the lows of late 2016, right now 103.90. Yesterday, the lows going all the way back to 2003. Euro dollar positive, about 0.1%. A massive ECB meeting less than a month away. That's the price action cross asset. Let's get you some single names, some movers, and say good morning to Kriti Gupta. Morning, Kriti.
Well, good morning, John. Let's talk about the major news of the day. Broken, of course, on surveillance. You have to talk about those Twitter shares. They are tanking down with a 38 handle. This, of course, comes after Elon Musk tweeted out that the deal is on pause as they look at simply calculating how many fake accounts, how many scam accounts are on there. They, of course, cited a Reuters report saying that it was only 5%. They're doing the math on that. But putting that deal on pause means that the shares do decline. Now, remember, the deal premium between the Twitter shares or in Twitter shares between the Elon Musk offer price has continued to widen. So it's really interesting to see that even if this deal is resumed, does it still get even closer or even farther away from that $54.20 offer price? But when you see Twitter shares drop like this, immediately the first thing that happens is Tesla shares rally. And you can already see that be the kind of effect. And we also know that Tesla is the heavyweight in the S&P 500. So every time Twitter shares drop, the S&P 500 is poised to gain simply because of that Tesla heavy weighting. That's your macro take on why you should care about this Elon Musk deal. Also talk about Robinhood here, because Robinhood is soaring up 21% this morning. This comes after Sam Bankman-Fried instituted a 7.6% stake in Robinhood. Remember, he is the 30-year-old crypto billionaire, the founder of FTX, that platform for crypto trading. Robinhood, most of their kind of trading volume comes from cryptocurrencies. That was a negative when cryptocurrencies were dropping. Right now, a positive given the new 7.6% stake. So, of course, we're going to keep an eye on these shares as well. Robinhood very much in the eye of the stock market this morning. We also should talk about big tech, because you are seeing a little bit of a rebound this morning. Apple shares, for example, up 1.6%. And I want to use this as a proxy for tech broadly, not just because of the heavy weighting that you saw similar to Tesla, Microsoft, Nvidia even, but also because of its relationship to the chip supply chain going all the way back into China. Overnight, you heard reports from Bloomberg actually saying that Samsung is looking to hike up their prices by 20%. That's going to be a positive for chip makers, but they're also looking to pass on the cost to consumers. And they think they can do that because of how strong the demand is. That is something that Apple is going to have to consider as well. Is Apple able to pass it on to its consumers? Nevertheless, that story boosting not just Apple, but Nvidia and Advanced Micro Devices as well.
Kriti, thank you so much. Greatly appreciate it this morning. Right now, a gentleman at Cornell. He studied economics at the bar of the Rongovian Embassy. Michael Schumacher joins us, global head of macro strategy at Wells Fargo. And when you have the courage to write the notes that Mr. Schumacher writes, folks, you not only put a rate on it, you put a date on it. Mike Schumacher is one of the very few saying, here's the terminal rate. Mike Schumacher, 3.05%. in the middle of next year, and then you go on to a higher statistic, is, well, what is the likelihood of that happening given the worries about a growth slowdown?
Yeah, Tom, we think the market has to price a lot more tightening by the Fed, and the reason is the policymakers are talking tough. And I know the market's faded the Fed countless times over the last 15 years. This one does feel different. Powell's basically penciled in 50 for the next couple meetings. So we think there's a pretty good chance that terminal rate gets up to 375 over the next few months. That'll feel really bad for risk assets, but that's really the idea, actually, is to tighten conditions quite a bit.
How bad will it feel for equities, given how much we've already priced in versus credit that perhaps and arguably has not priced this all in yet?
I think I've talked my friend Chris Harvey off the ledge, Lisa, but I suspect that's probably another downturn of 10+%.
Wait. Hold on one second. You think that there's another 10+% downside within credit?
Oh, no, in equities, sorry.
In equities,
credit,
okay. In credit.
Can you tell us, Mike, how Chris responded to that, given that he's got, I think, a 47.15 price target on the S&P?
It's not the day to quantify these things, John. It's Friday the 13th. A lot of strange events happen, so I'll leave that to Chris, but down a bit.
Yeah, but John, the problem is Harvey's standing on the ledge of the bar at Benoit on 56th Street, and it's only like a 2-foot
I think there's probably going to be, I guarantee there's an email waiting in Mike's inbox from Chris.
Continue.
In a few minutes' time. Mike, let's work through this. You had a big call on the front end at the start of this year. It was kind of out of consensus. I remember looking at it. I think it was about 150 or something on a 2-year, and I thought, okay, that's punchy. We've blasted through that, Mike. Have we done everything we need to do with the front end of the curve? Is that done, dusted, finished?
I don't think so, John. And it's interesting, right? Because you think about how much tightening's priced in over the next couple meetings, fine, 50 each, sort of boring. But for the end of this year, it's been bouncing around between 185 and 200. That seems to be sort of where it's going to land. But our big issue is how little tightening is priced for next year, 30, 40 basis points. That's a joke. You think about it, the biggest inflation worry in actual reality in the last 40 years. And how can the Fed or other central banks, for that matter, really think to get it under control in 12 months' time? I think that's incredibly implausible. So we expect a lot more tightening to be priced in for 23. That pushes up the 2-year, pushes up the 3 years. So a lot more work to be done there.
Michael, speaking of work to be done, you are way out front of the weekend notes we're going to see, and frankly, the notes into June, which is the party is over on a goods supply chain analysis, and that inflation is greater embedded into our system. Does Wells Fargo model a path to 4%? Or an Adam Posen 3%? Or can you actually model back to a 2% level?
Yeah, 2% seems aspirational at this point, Tom, I think, to put it kindly. And you've got to say, well, where are the central bankers likely to declare victory? If they got inflation down to 3%, let's say, in 18 months, would that be good enough? Maybe that's still too high. 250, I think they're done. So 2% maybe in many, many years, but not in the next 1 or 2. That just seems
so, Mike, this is a
too far.
forecast-dependent Fed still then. Ultimately, they get down to, say, 4, and they forecast 2, and then they're done?
I think that the deal here, John, is that the Fed's going to have what I would call a binary discussion maybe in 5 or 6 months, and they'll say, look, inflation's down, almost certainly, probably down a fair bit. And this is what a lot of people discussed. And then how does the Fed read that? Is it the pace is good enough or the level still bad? And we don't really know the answer to that. So I think the Fed it's looking at the actual data coming in, paying a lot less heed to its models than it has in the past. But that really multiplies the chance of an overshoot and too much tightening.
Mike Schumacher of Wells Fargo. Mike, tons to think about there. Thank you, buddy, and good luck with Chris when you get back to the office. It's a range of things you can look at when you're trying to work out whether we formed a bottom. When the bond guys start talking about equities, Lisa, I wonder if that's when we're starting to get close.
Wow.
The fixed income strategists come on and start saying, more downside here.
Did Chris email you and
I haven't
basically
heard
tell
from Chris.
you
I'm
to
going to reach out to Chris in just a moment.
Push a little bit there.
And see what he thinks of that.
Honestly, I do think that that's interesting, and I wonder whether that logic has been turned on its head in this particular cycle, just simply because we haven't seen the scope of pain within corporate debt that we have in stocks, and there has been so much baked into specific names. That said, he's not alone in thinking that there really is more downside. A lot of people would agree.
People might suggest the bond guys are always looking for downside in equities, Tom. Isn't that the way?
Yeah, it is. And your insight, John, on bond people talking about equities is important, but far more importantly is two things. Equity people talking about bonds.
Always.
And critically, I've said this for years in speeches, the dialogue changes from a yield analysis to a price analysis in crisis. And that's one of the measurements of catharsis, and we're not there yet.
When do we get to hear its own Keene speech? I like that, Tom. You just slipped that in. You've said that for years in
No,
speeches.
I've done it. I've said this for years.
Tom Keene
no, I've said this for years.
Over the
There's a
Swanson
moment in panic where bond people switch from yield analysis, which is comfortable, to the direct analysis of price. And you see it in the Bloomberg Total Return Index. It's the worst, Lisa, what, ever? Is that the right word?
Poised for the worst year, ever, if the losses do hold. Although we retraced some as people start worrying about growth, which goes to the point of, frankly, Steve Englander and not Mike Schumacher. And I wonder, John, if Mike Schumacher is right, what does that do to the dollar, right? What does that do to the euro?
Sure. Barry Knapp just wrote in, bond guys, always negative because the best they can ever get is par. Barry, it's true. Thank you, Barry, for tuning in.
There are other reasons why we're negative.
A whole host of them. We. Did you like that? We. Did you like that? We.
Time.
Lisa, part of the we. Futures up by 1.2 on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Laura Wright. Shares of Twitter are in a tailspin. Elon Musk tweeted that his proposed $44 billion takeover is on hold until he gets more information about the proportion of fake accounts. In a recent filing, Twitter said that fake accounts on the social media platform make up less than 5% of its users. Some European Union nations say it may be time to consider delaying a push to ban Russian oil. The problem is they can't persuade Hungary to back the embargo. By putting the oil ban on hold, the EU could proceed with the rest of a proposed sanctions package. The UK's Chancellor of the Exchequer, Rishi Sunak, says the Brexit settlement in Northern Ireland is causing economic and political harm. On Bloomberg Television, Sunak was asked whether the UK would take action on its own.
No decision has been taken. Our preference has always been to have a negotiated settlement. I know the Foreign Secretary continues to engage with her counterparts in Europe about how we can find resolution to some of the very real challenges that the protocol is causing.
You can get more on that story from our new Bloomberg UK website, your premier destination for business and financial news in Britain. Just go to bloomberg.com/UK. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I think we're in the final stage of what is going to be a significant bear market. What's taking place in terms of the equity market now is a rationalization or a recognition of the fact that the Federal Reserve is not going to be executing the Greenspan put anytime.
That was Steve Rasciuto, an economist from Mizuho, talking about equities. You've had a bond market strategist do that too this morning as well. So there we go. Heard a lot from many of you this morning. Here's another one. Bond guys are not negative. They're realistic, Tom.
Thank
How many
you.
times have you heard that? Lisa loves
Amen.
that. They're not negative.
Preach.
They're realistic. Futures up by 1.2 TK on the S&P. On the NASDAQ, up by 1.9.
John, let's frame this, and I think it's serious. It signals to me the great disinflation, the great Volcker movement that we've had, the great moderation, and most of the people breathing today have never enjoyed a bond bear market. I can't say enough how it's important that you look at 3, 4, 5, 6 months or even quarters of statements and you're not making anything in bonds. It's been a long time, John, since we've seen that.
What they've also enjoyed, Tom, is when the going gets tough, the Federal Reserve offers them a little bit of support.
Yeah.
This from President Daly, I think, is one of the most interesting Fed interviews of the week, by far. To hear President Daly say this to Bloomberg, I expect financial conditions to tighten even more. I would like to see continued tightening of financial conditions that would be consistent with bringing supply and demand back into balance. That's something you will not have heard once in the last 10 years when the market's down close to 20%, Tom. That is not what we're used to.
Well,
that's the big change.
It's original territory, as they say.
Is that what you're calling it?
That's what we call it. Futures up 45 right now. This is a joy and a great pleasure. Barton Crockett is a gentleman of certain courage. He's at Rosenblatt Securities and joins us right now. And as all of you look at your drawdown, let's pick Amazon down 42% from the peaks. Crockett lonely was out front. He has been a consistent neutral as a general statement on the FANGs for quarters and quarters and quarters. Barton, I want to drill down to one emotion right now, which is, does Jeff Bezos come back to Amazon? Is Amazon online retail so screwed up that, like Iger at Disney, Bezos must return?
No, Bezos isn't coming back. He's enjoying life. I think that the focus at Amazon for growth is going to be on Amazon Web Services, Amazon Retail, their direct-to retail, their third-party retail, is a business that I think is doing what every business should do, which it's gotten so large that I think it is hitting a maturity plateau. And if you look at the numbers for Amazon Retail, for a few quarters now, they're not growing faster than retail overall. And that's 70% of sales for Amazon. And you could argue that that's not the driver of value. The web services is, which is, I think, the saving grace for the stock. But a big revenue line, I think, is resetting. I think the growth story of Amazon is different now because of the pandemic. We've had a pull forward. We've had the competitive set improve. You've weeded out the weakest players. And Amazon doesn't have a strong play in click and brick. And that's a meaningful part of what consumers are looking for right now.
Barton, with the pullback that we're enjoying here, would you suggest that the anointed profitable of technology are going to have a come to Jesus moment, and they're going to change their business models more towards profitability and use of free cash flow?
We're already seeing changes. We're seeing Amazon work through excess supply. Remember, a bull argument for Amazon was that in the pandemic, they built up the supply that would power the business because it would give them the capacity to meet the demand. And instead, they overbuilt. So they're having to right size to reality. We're seeing that in other businesses, a tighter focus from these growth stories on what life is when you start to face more maturity, which is what a lot of these big companies are coming into right now.
So talking about right sizing, we've seen a huge right sizing in Twitter share prices today. We've seen Elon Musk come out and say that he was going to put it on hold, but then he just came out recently in the past few moments saying that he was still committed to the acquisition. You're seeing a bit of a pop near $40 on the shares, but still a deep skepticism that this will get done at the deal, at the price deal that he was talking about. How much of a re-rating do you think needs to happen further, based not just on Twitter's model, but also on the broader reevaluation of how much some of these big tech companies are worth?
Well, I think in the case of Twitter, I think that this is Elon Musk being Elon Musk. I think at the end of the day, he's put himself so deep into the water on this one that I don't see it. I don't see him turning back. If he did turn back Twitter, there'd be some sentiment reset. But I think on a fundamental basis, I don't think he actually paid much of a premium. I think that Twitter was not as mispriced as perhaps some other equities have been. Look, I think that what we're confronting right now is separation from some companies. So some companies are confronting the reality of an addressable market that is not what we thought. We're seeing that with Netflix. I think we're seeing that with Amazon Retail. Other companies, I think, are going through situations that are going to be long-lived. And I put Apple and China, the never-ending COVID lockdowns, what that does for an important end market, what that does for never-ending supply disruptions. I put them in that camp. For businesses where the blue sky story is not what it was or is being challenged, I think right now is a time of reset and a time of rethink. For companies that are going to be able to power through this, and I put Alphabet in that camp. The search business is something that'll be here generationally. YouTube, I think, can handle its short form transition. Cloud services, I think, that's a company that I think can separate. So in the FANG group, that's the one company that I'm recommending. The other companies, I think, have issues that need to be worked through.
But on one issue with Twitter, and let's finish there, just on the substance of the tweet from Elon Musk this morning. He's basically probing this idea that there might be more than 5% of the user base that make up spam, fake accounts, bots, and all the rest. Have you got any calculation on that whatsoever?
No. I mean, there's no one on the outside that can go beyond Twitter's disclosures. nor can Musk. I don't think Musk knows. I think this is talk. I think this is him doing what he does, which is stirring up the pot. And so, the caveat is that, I'm not Musk. I don't know precisely what he's going to do, but my bet would be that this is talk.
I think that's got to be the
substance.
bottom line. No one knows what Elon Musk is thinking. Let's not try and work that out. Barnard Crockett, Rosenblatt Securities. I guess a lot of people getting paid a lot of money to try and figure that out right now. This market's been whipsawed by this. Just one name, whipsawed by two tweets. The first one, Twitter deal temporarily on hold pending details supporting calculation that spam fake accounts do indeed represent less than 5% of users. Stock gaps lower by almost 25%, Lisa. Then the next tweet, still committed to the acquisition. Brief pop, we're negative about 11% now on the stock.
Trying to work through what's going on in his mind is a tough one to handle. I think going back to what Barton was talking about, how this was a stock that had already repriced dramatically in a way that the other big tech shares had not, and it hadn't necessarily baked in the same kind of optimism. How much is this? Elon Musk just trying to get a better deal.
It's back at 40 in the pre-market. The agreed deal, 54.20. Coming up shortly, Jim Paulson of Leuthold Group on this equity market, which has just been absolutely bruised and battered year to date. On the S&P, at 1.3%. This is Bloomberg.
I think we're in the final stage of what is going to be a significant bear market.
The market is simply on edge, and they are clearly running to safety.
You're entering into a very challenging growth inflation mix, where I think inflation is sticky, growth is decelerating.
We know that growth is likely to slow down over the next 2 years. We're actually anticipating recession in early 2024.
Is it a soft landing? Is it a recession? Is it stagflation?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. We stagger to Friday. Maybe we stagger into the month of June. A lift to the market today. But, John, listen to the people in the show opener there. All of them, even Gabriela Santos at J.P. Morgan, doom and gloom.
You say working our way to June, Tom. We've still got 2 weeks left of May. It's felt that bad, hasn't it? We're only 2 weeks into this thing. Equities right now up by 1.5% on the S&P 500, and the Fed's not coming to the rescue. Bottom line, we've heard from so many Fed speakers so far this week, and I keep going back to the words of President Daly. I would like to see continued tightening of financial conditions. This is not a bug. It's a feature. It's the goal.
We're going to talk to a savvy market expert on this in a moment. But, John, to me, the major shift this week is nobody's talking about getting inflation back to 2%. It's somewhere up there, and there's a huge mystery to the glide path of a successful Fed.
We've talked about this a lot, Tom. It's not about where it peaks. It's about where people think it will stabilize and how much work the Fed will need to do after that. Citi just put out a note. They think August is really, really important. We've talked about that a lot. That's when this Fed regroups. They get to reassess. They've got several inflation prints in their back pocket. What do they think the glide path is? How much further beyond neutral might this Fed have to go?
Lisa, inside baseball, what did we learn from the auctions this week? Seriously, what did we learn from the auctions about the tumult of price down, yield up?
This real debate that's going on within the bond market of rate fears versus growth fears. Growth fears took the upper hand. But I think the big takeaway, both from the bond auctions as well as the broader market action this week, really was that we're probably not going to be out of this push-pull environment for a while. This could be such a choppy market. We hear from people who say, what if we just see things flatline, but under the surface, get this churn every day, up, down, up, down. That's the most uncomfortable kind of place for a trader to be in.
I got like 8 ways to go here, folks, and I'm going to have to promote Ferro's show this afternoon, The Real Yield, folks. Look for that. And, John, a lot of people are saying I still have to look at inflation-adjusted yields. How can I look at inflation-adjusted yields if I don't know where inflation's heading?
Well, they're just about positive right now, Tom. Just about 26 basis points on a 10-year. That hasn't been the story, has it, over the last few years? It's been negative real yields. Now they're positive. Only just. And look at the pain it's already causing in the equity market, Tom. That's the problem for a lot of people. We've had 75 basis points of hikes. QT hasn't even started. I understand that markets are supposed to be anticipatory. I get all of that. I understand the Fed funds path, what it might be in the future. I understand all of that. But to see this much, this soon, before QT's even kicked in, it's quite something.
Folks, Ferro paid in pounds sterling. I'm buying drinks this afternoon. John, we just got a 121 handle on sterling. To me, inside baseball, that's a shock of the week. Week Britain.
The Bank of England faces something a lot of people are fearing the Fed might have to face further down the road, that they have to hike into economic weakness. That's the big fear, isn't it? So we're seeing interest rate hikes at the Bank of England, but we're seeing a weaker currency. We're seeing the prospect of ECB rate hikes, but we are seeing a weaker currency. This is a new dynamic that we're getting used to in foreign exchange, in G10, in developed markets more specifically.
On data, DXY at 104. John, I'm just going to look at sterling, 122.01 right now. And more important to me, John, is watching a little bit of Swiss franc strength in the last 3 days.
Futures right now, Tom, up 55 on the S&P, advancing 1.4%. On the Nasdaq 100, up by 2 full percentage points. So there's your bounce. Still heading for a 6th straight week of losses, but looking for a strong finish to an ugly week. Yield higher by 6 basis points to 291 on a 10-year. Tom, you've mentioned foreign exchange. Look at crude, 107.76, up another 1.5% on the day.
That's the West Texas Intermediate, 109 and 110 print on Brent crude gets my attention. If you're at home afraid to open the envelopes from your various and sundry investment houses, this is not only the interview of the day, but the interview of the week. James Paulson's been doing this a few years. He's chief investment strategist at the Luthold Group, and he writes an incredibly intelligent, complete note up and down about the courage to stay in the market. How am I not 100% in cash right now, Jim Paulson?
I wish I have been all year, Tom. I thought this thing bottomed out there in March when it rallied, so I'm a little gun shy too. But I look at this in a little different way. Everyone's looking at this as, is it a cycle-ending bear market we got coming here, and the economy is going to recess, and there's so many issues and problems. I look at this more as a normal correction that generally occurs in the second year of a bull market. That happened in 83, 84. It happened in 93, 94. Happened in 2004, 2010, 11. Mainly for the same reasons. At that point, the economy picks up, inflation starts to become an issue, the Fed starts to tighten, rates start to go up, and people are concerned. The market often has a rough year and then ending in a nasty correction. And this one is still a lot like the other ones. And there's always great fear at that moment, which there is today. But I think that the fears we have today are tied to one thing. Really, inflation. That is the elephant in the room. All the fears we have about how high yields have to go, how many times the Fed's going to have to raise rates, how much behind the curve they are, whether they're going to have a policy blunder, ultimately a recession, are tied to the inflation rate. And I think there's growing evidence that it peaked in March and it's going to continue to moderate as we go through the rest of this year. And if we get this thing down to like 6%, I think people are going to calm down a fair amount here. You know, the history of inflation spikes, the 70s were a little different, but the history of inflation spikes in the United States, almost all of them are not rounding tops. Most of them are spike tops, and they come down quite quickly. And I think this one could be fairly similar.
Jim, before we move on, can you help me understand your definition of a correction and a bear market? What is the distinction for you?
Well, there's the 20% that's put out there. I don't even know where that came from, really. It's the difference between 20.1 and 19.9.
Well, Jim, that's why I asked, because we were basically there yesterday. Yeah. And if we closed there, we would have had the headlines all over the place, bear market. NASDAQ's already there. Some of the massive names out there are already down by more than 20% from the highs of the last 52 weeks. So what's the difference for you?
To me, it's not. I think the difference for me is not so much how much the market falls, but is it a recovery economic ending event? Is it down because we're going to have a recession, which means it could stay down for a while or go down a lot further? Or is it down because it's a corrective force in the market against rising fundamentals? And I would be in the latter camp in that right now, Jonathan. I see economic growth slowing, which it's slowing to a very healthy rate. That's probably going to be 3% or so in the real terms and much higher than that in nominal terms in the latter half of this year. And that's still maybe 50% stronger than what we've had for the last 10 or 15 years overall. But look, we created over 500,000 jobs a month in the first 4 months of this year. Leading indicators are still rising. Profits are going up. Profit estimates are going up. Junk spreads have come up a little bit, but they're still pretty tight. I don't see the recession force. And if I don't see the recession, then I think this is a correction as opposed to a bear, even if it breaks 20%.
It's been very specific in terms of which stocks have gotten most pummeled. And John was mentioning that NASDAQ's already in a bear market. It's seen about $1 trillion of market value wiped away this week alone. How much is this a bubble that has burst? And how much is this a reset that has legs that should continue in terms of especially what's going on with China's supply chains and semiconductor prices going up?
Well, I think this correction's done a lot of what corrections do, Lisa. If you think about it overall, we have we've taken a lot of the leadership concentration out of this market already. The tech leadership has come down a lot. You look at the FANG weighting was almost 14%. It's now down to about 9%. You look at ARK Fund, it's given up its entire relative performance. It's now back on a relative basis to where it was in early 2017. The weighting of the tech sector has come off, a lot already. So I think a lot of that leadership concentration's gone. We've certainly revalued this stock market in a big way. On future earnings, the S&P is getting close to dropping below 17 times earnings, down significantly from what it was. We've now paused the rate route here for the last few weeks. That often happens at lows. And then finally, we've scared the EBGBs out of us. I'm nervous. Everyone's nervous. And that's what it does. It beats down that positive sentiment. As you said, all you see is negative headlines. To me, really great fear on Main Street, on Wall Street, combined with, I think, ongoing good fundamentals, including strong balance sheets in the household sector, the corporate sector, and the banking industry. I think that's a dynamite combination you have to buy on rather than do what you want to do, and that is turn and run.
Jim, wonderful to get your perspective. It's a different one. Jim Paulson there of Luthold Group. I think the biggest difference here, Lisa, in Jim's words, is it cycle ending? Is it a head fake? Is it 2011, 2015, 2018, or something much worse?
Does it necessarily have to be cycle ending in order to get the result that the Fed is going for, which is lower inflation? And that, I think, is sort of the conundrum that people are dealing with right now, John.
The team at Bloomberg came out with some numbers on this, just on the S&P 500. When the S&P 500 is down 20%, which defines a bear market for many people, the last 14 times, in the last 95 years, in just 2 of those episodes did the American economy not shrink within a year, 1987, 1966. Those numbers from the team here at Bloomberg. I think that's really interesting. Futures on the S&P up by 1.38, on the NASDAQ up by 1.95%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Laura Wright. Shares of Twitter are in a tailspin. Elon Musk tweeted that his proposed $44 billion takeover of the company is on hold until he gets more information about the proportion of fake accounts. In a recent filing, Twitter said that fake accounts on the social media platform make up less than 5% of its users. Musk also tweeted that he'd still committed to the deal. The Senate was forced to postpone final passage of a $40 billion Ukraine aid package after Republican Senator Rand Paul refused to allow the vote. Paul is demanding that lawmakers add a provision to appoint an official with oversight powers for the aid. The Senate is now expected to vote on the matter next week. Federal Reserve Chair Jerome Powell has reaffirmed his plan for raising interest rates to fight inflation. In an interview with the Marketplace radio program, Powell said the central bank is likely to raise rates by a half percentage point each of the next 2 meetings. He pushed back on speculation the Fed's considering a 75 basis point move, however. A stealth wave of COVID is making its way across the US. Those who have so far evaded the virus are falling ill, and others are catching COVID for the 2nd, 3rd, or 4th time. Still, the rise of at-home tests have made keeping accurate count of positive cases impossible. Experts say that it's difficult to know what the next few months will bring. Bloomberg's learned that Samsung is in talks with clients to charge as much as 20% more to make semiconductors. The South Korean giant would join rival TSMC in passing on rising material costs. Price hikes would mean more pressure on makers of smartphones, cars and games consoles to lift the prices consumers pay. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. This is Bloomberg.
I will provide a new political impetus for an agreement. I'm sure we will have an agreement. We need this agreement, and we will have it, because we have to get rid of the oil dependency from Russia.
They're still talking about it. Joseph Borrell there, the EU foreign policy chief. From New York City this morning, good morning. Futures up by 1.45% on the Nasdaq, up by 2 full percentage points. Yields are higher by 5 or 6 basis points on a 10-year to 290.58. And if we can take a sneak peek of the drama of the morning, the soap opera that is Twitter, the stock is down by about 11%. It was down by about 25% at one point this morning, off the back of just a couple of tweets from Elon Musk. Here's the first. The Twitter deal is temporarily on hold, pending details supporting a calculation that spam fake accounts do indeed represent less than 5% of users. And then about an hour later, maybe two, Elon Musk says, still committed to the acquisition, Tom. The stock at 40 now. The agreed price, $54.20.
John, can I suggest, since he's the one going after the company, he's allowed to make these statements? You know, it's not like he's breaking SEC law or anything.
I won't get involved in what he is allowed to do and what he's not allowed to do. I would state that if you have an agreement with a company, you can do your due diligence, and that's something he's trying to figure out.
Trying to figure out, to say the least. Right now, and moving forward into the summer, it is a joy to speak to Angela Stent. She is non-resident senior fellow Brookings and author of my book of the year, made far too early in this tumultuous 2022, Putin's World. All I can say is it's definitive. Professor Stent, thank you so much for joining today. Here's what Wikipedia says about Mr. Putin's health. These claims are speculative and made by those who are not medical professionals. So, Dr. Stent, I remember you on Dr. Kildare a few years ago. How is Mr. Putin's health?
Well, I am not a medical doctor. Good morning. So it is all speculation. I mean, if you looked at him on Monday in the May the 9th rally commemorating the anniversary of the defeat of the Nazis, he didn't look quite, as robust, let's say, as he's done on previous occasions. His speech was very short. We all expected something longer and more bombastic in a way. I mean, it was still pretty aggressive, but it was kind of toned down, and he didn't make really any news, which people thought he would. But we do have to reiterate, it's all speculation. I've seen on Twitter many people claiming to be medical professionals who've diagnosed him with a large number of ailments, but we just don't know the truth.
Dr. Stent, you have studied Napoleon to Moscow, Hitler to Moscow, and now Putin to Kyiv. Is his military overextended?
I think it is. I think they're doing much less well than people thought. They're even having a very hard time taking the rest of the Donbass. They have taken some territory in the past few weeks, and they're grinding on. They're still just as brutal. But one would have thought that they would have been able to take more territory. You have this kind of dynamic stalemate now in the Ukraine war. The Russians take some territory. The Ukrainians push them back. The Ukrainians are now pushing them back from Kharkiv, the second largest city. So they are not performing as well as people thought they would, but they still do have the firepower and the manpower. So they're going to continue this grinding war, I guess, as long as they can, until they achieve some of their objectives.
Angela, how much raw equipment do they have left that doesn't need any repairs? And I ask this because a lot of people were talking about the sanctions and how it would prevent imports to Russia of some of the key aspects to fix, for example, tanks, to fix other issues, their planes. How much is that starting to bite?
Oh, I think it's definitely starting to bite exactly with the sanctions and the spare parts. I mean, they still do have equipment, but as far as we can see, it isn't top shape. It isn't in great shape. So it's going to get more challenging for them going forward.
With respect to gas and oil, and I want to pivot to that point because we are hearing so much about ongoing negotiations in Europe, how would you characterize them? Because there's so much uncertainty of what they've agreed on, what they're planning to do, what groundwork is actually getting laid. How realistic is it to see a real shift away from Russian gas in the near future?
So at the moment on the oil, they're still arguing within the EU about a total cutoff. Particularly Hungary is a holdout and says that it's not going to stop importing Russian oil because that would be devastating for its own economy. One assumes that they're going to continue these difficult negotiations and try and come to some compromise with the Hungarians. And then with gas, it is more challenging. I mean, the Germans have now said that they do want to get off imports of Russian gas, but they can't do it tomorrow or even in 6 months. It's going to take them a longer time. The Russians, of course, threatening and actually cutting off some of the gas supplies already. So that's a rather messy set of negotiations, but they're continuing to try and figure out how best, that is Europe, can wean itself totally off Russian energy, but it'll still take time.
Angela Stent, years ago, I remember asking the giant Marshall Goldman this question. Let me ask the same one to you. We were wrong about the strength in our intelligence of the Soviet Union. Do you believe we have a good understanding of the strength of the Russian army, the Russian military complex, including Navy?
So I think we overestimated the strength of the Russian military, just apparently as Putin did. I think even our intelligence services have been surprised by how badly they've done, because maybe we just didn't have insight into the impact of this pervasive corruption, where a lot of the money that was supposed to have gone to new equipment, to training, to building up the army is lining people's pockets. And maybe we just didn't understand that well enough. And I think we're now trying to reassess our previous assessments of the Russian military and maybe downgrade them. But I think it's sort of natural that any intelligence agency will look at the worst case scenario, because that's what they have to do. And therefore, they probably did overestimate how quickly the Russians would be able to accomplish what they're trying to do in Ukraine.
Angela Stent of Brookings. Angela, just wonderful to have you on the programme as always. Angela, thank you. Tom, the risk is always that this goes on a whole lot longer than people anticipated and that the electorate, perhaps the support from the electorate for government and officials going forward from here to carry on doing what they've been doing, that wanes somewhat as the economic pain starts to get driven home a whole lot more.
Yeah, well, it's again, it's the week by week thing, and we're getting long in the tooth here. But John, this is true, I think, of so many wars. Most wars are started out with a short-term framework.
Yeah.
And then it changes, and we're right on the cusp of that, and then it changes.
It's an absolute tragedy. And Lisa, is going on a whole lot longer than people hoped.
Yeah, and just one tragic picture after another and headline. The ramifications on the global economy, though, just to put this into perspective, we talk about oil and gas, but food prices continuing to climb. People actually talking about how some of the weather hasn't been conducive to boosting crop output in other places. This is going to come to bite, and we already is in a major way around the world.
Scott Minard of Guggenheim just wrote in. Scott, thanks for watching and for listening. He says the following: on recession and the recession debate, interesting to note that the Fed has never been able to reduce inflation by more than 2% without inducing a recession. And Tom, that's the ultimate fear a lot of people in this market have.
Oh, yeah, that's really well said, John. It is the ultimate fear that's out there right now. But I would look at a lot of secondary, almost tangential ideas that really need to be watched. And again, like Chairman Powell, we're all data dependent here.
Futures up 1.3% on the Nasdaq, up by, let's call it 1.94, call it 2%. You've got to bounce. Yields higher too by 4 or 5 basis points to 289.67. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance. Going into the weekend, we're almost there. On the S&P, futures positive 1.36% on the Nasdaq 100. Futures up by 2 percentage points. Yields higher too by 5 basis points, 289.49. Bit of economic data coming up through today, including UMich, University of Michigan Consumer Sentiment. Looking forward to that data. Yeah. Lisa went through things for us a little bit earlier. Kashkari, Mester on deck. We'll hear from them too. And then on to next week on the 17th, retail sales in America. The big one, Tom, I think, to look forward to.
John, I'm going to go back to 121.87 on sterling. I'm sorry, sterling can't get a bid. Is that?
Hey, Tom, it's the hangover from last week. It's the hangover from last week in the Bank of England. That was just dreadful.
Well, we will see. Right now, we are thrilled to bring to you Raghuram Rajan. He is, of course, at the University of Chicago Booth School. He is, of course, a former Reserve Bank of India governor, but also one of the most prescient students of American culture and our future. We're thrilled that Dr. Rajan could join Bloomberg this morning. Raghuram, I want to go back to, I think it was 2012, and your postmortem in the corporation and finance, where you talked about the near-death experience of 2008. How close are we to that now? When you look at the unique challenges every central bank happens, including the work at Bank of India 10 days ago, I will say, how close are we to a 2022 near-death experience?
Well, every episode is different, of course. I think we are not as fearful of the banking sector this time because of substantially more capital in that sector. What is less known is what happens in the shadow banking system, the cryptos, the finance companies, the various funds. And what has happened over the last 10 years is we've had very easy money. Very easy money means leverage. Very easy money means a dependence on liquidity and a dependence on being able to roll over stuff. And the big unknown is how many, how much of the financial sector is actually going to have problems as rates go up, as rollovers become more difficult. Yesterday, day before, we saw that happening to stable coins. What else is waiting out there?
Right.
Buy now, pay later. Yeah.
What's so important here, Dr. Rajan, is the University of Chicago's intellectual foundation and leadership on the breaking of inflation by Paul Volcker a few decades ago. I know history doesn't repeat, but what are the methods we need to do to break this inflation?
Well, Paul Volcker used a sledgehammer, right? He essentially created a double-dip recession in order to squeeze out inflation. We hope it doesn't come to that this time. Nevertheless, I think the message from Volcker is as inflation gets legs, as it picks up, as it spreads, and it spreads not just within the country across goods and services, but across the world, you have to take strong medicine. And that means raising rates typically a percentage point or two above the prevailing inflation rate. And right now, we are so far from it. Now, the good news, I think, is when you look at inflation expectations over the last few days, they seem to have come down. That's an interesting development. People think the Fed is serious. The markets may not be perfectly right, but they certainly think the Fed has a chance now. You look at five-year forward expectations, they had gone up to 2.5%. They're back down to 2.3 now. So there's something here suggesting the market believes the Fed is serious.
Raghuram, you're talking about the concern about financial stability as well as this belief and faith that the Fed can actually bring down inflation, that they're actually going to go ahead and do that. In some ways, does the Fed get more conviction to go faster and more from the fact that the disruptions, whether it's in the stable coin that you talk about, whether it's the fact that we've seen massive amounts of pain in the big tech sector, that we have not seen a wholesale financial market collapse in some of the shadow banking sector? Does that give the Fed more confidence that they can raise rates at the pace that they're planning to?
I think it does. I also do think that, the fact that the market was not reacting earlier in the year to anticipation that the Fed would do something, certainly into late last year and early in this year, that was a source of concern. Everybody knew the Fed had to start raising rates. And you wanted some of the sort of oomph behind the market to die down. Now that has happened, but as you said, it hasn't resulted in a wholesale collapse. It has been, steady declines. That's not a bad thing. Of course, the Fed is wary. It doesn't want to cause a market collapse. And that, if that does happen, it may have to rethink a little bit its strategy. But certainly, steady decline is not a bad thing for the Fed.
Meanwhile, the great Fed conundrum of 2022 is just how much growth has to come down in order to meet their goal of bringing down inflation in light of some of the supply chain disruptions, the supply side issues that have really caused this. Where do you weigh in on this? As a former central banker, as a former head of a central bank that had to make some of these hard decisions, do you think it's worth it to curtail employment, to potentially send the economy into a recession, if that's what it takes to bring down inflation?
Well, there are two sources of concern, right? One is that inflationary expectations get more entrenched as you see higher inflation over a sustained period. And the second is that translates into workers demanding higher wages, and you get the wage price spiral, workers demanding higher wages, causing higher inflation, causing them to demand more. Now, there are two ways to break this. One, of course, is to bring down inflation so expectations come down. The other is to take some of the heat off the labor market, to create some slack so that workers now say, well, maybe inflation has gone up, but I'd rather prefer having my job than going out demanding a wage hike. And I think you can work on both. Now, I think the possibility of having a softer landing is certainly one that has been talked about a lot, an increase in labor supply as COVID sort of fears come down, but importantly, as immigration picks up and floods the lower end with a few more people taking the heat of the labor market in that at that end, and that can transmit upwards. But I think these are things that take time. I think the Fed has to act to show that it's serious and hope that these forces sort of kick in down the line and prevent that recession from necessarily happening.
Raghu, very importantly here, your book, The Third Pillar, was one of my books of the summer. You talk there about the elites of America leaving the community behind. Give us an update. I don't think it's that pretty, is it?
It isn't. And my big worry is that we've spent $6 trillion, but a lot of it was income support and not so much on structural reforms that would strengthen the capacity of those communities that are disadvantaged, that are falling behind, their capacity to earn a stronger living, to have stronger institutions. Now, I think we have a chance. I think with the increase in technology, the ability to work from home that we've learned during the pandemic, maybe economic opportunity can spread more widely, that people in skilled services don't have to go into the big city every day. They can stay in more remote places. They can fertilize those places with their capabilities, with their incomes, and you get a spreading of economic activity. But we have to work on this. We have to do far more. And I think if we do more, it will reduce some of the divide that plagues not just the United States, but almost every industrial country. We do have to build up elsewhere, level up, so to speak.
Raghu, I always enjoy listening to you. Thanks for being with us for so long. Raghu Ramrajan there of the University of Chicago Booth School. In the next hour, fantastic lineup. Mohammed Al-Arian in the studio for the hour, alongside James Athey of Aberdeen, Brian Weinstein of Morgan Stanley, Sarah Hunt of Alpine Woods, and we'll catch up with Michael Nathanson of Moffett-Nathanson on the whipsaw. The volatility we're seeing in Twitter stock this morning, Tom.
And you wonder what the next announcement will be from Mr. Musk. He sort of went one-way gloomy, stock went down. One-way constructive, stock went up. Now what? What's the next tweet?
What did they say? Bramo committed to the acquisition.
Yeah.
Is that what he said this morning?
Yeah, maybe that'll be what he tweets. Maybe it'll be, 420 and then ha, ha, ha. I mean, we don't know, right? We don't know what's going to necessarily come. It will move markets.
Can you say hi to Dr. Al-Arian first?
Of
for
course,
those of you
Tom.
on radio, I wore my New York Jets bow tie.
Is that what you did?
Just for
Is
him.
that what
It's
that
a
is?
green-
This is your
green bow
opportunity now. We have about a minute, Tom. Do you want to do the match review that you've been desperate to do the whole morning?
No, I just think, they look destined. But John, explain if you lose a person. It's not like in hockey where you lose someone and you can replace them or you're a penalty down. A red card means bye-bye, right?
That means you're down to 10 men for the game from 11. You got to play with one less man.
How often does a 10-man team compete with an 11-man team?
Quite difficult, especially when it happens that early in the game, like it did with Arsenal versus Spurs yesterday.
I don't, I was at Antwerp Arms afterwards, and people were
I saw you
stunned
researching
that
the
they
bars
could say,
and the pubs in North London.
Well, I like
after
Antwerp
the
Arms
game.
because, when you leave White Hart Lane, it's a little bit farther away.
Have you made a choice then? You've got your favourite pub for when you first make it.
No,
to
it's
watch
when I
your
go
first
to
Spurs
it,
game.
and then afterwards, you've helped me a lot on this.
That's what I'm here for, Tom.
And the flight from
Nothing else.
Heathrow is brutal.
Bramo, you coming to this?
What?
TK's first game.
I was looking at yields.
Is that what you were doing?
No, I mean, honestly, I like to leave you guys to have your
What did Tom
moment
call
of
it?
zen.
Boy chat. Is that what he called
Just
it?
totally
Lisa,
offensive on a deep level.
Not offensive at all.
I mean, like,
Lisa,
just
you
totally
can bring your phone when we go see Tots, whoever.
Oh, I'll be into
and
it.
you can look at your Bloomberg.
Bramo watches
worksheet.
football on the weekend.
I do, actually.
I
And
know you
know,
do.
I used to play soccer.
I know
enjoy
that
it.
too.
And I call it soccer because I'm,
Well, Bloomberg style, just to clarify, is now football.
Okay, all right. So I'm violating Bloomberg style.
Unless you're talking about Major League Soccer played here in America, everywhere else we refer to it as football.
Thank you.
I had a chat to
That's
a man
news
from
you can
Leicester
use.
about making that
Oh,
happen,
did you?
Tom, and that has happened.
That was your fault?
No, it's the man from Leicester that makes the call. At 1.4% on the
How's
S&P.
Leicester doing this year?
Not good.
Like I'm gonna be relegated
Not
as
good.
well.
This is Bloomberg.
Keeping you up to date with news around the world. With the first word, I'm Laura Wright. Elon Musk has put his $44 billion takeover of Twitter on hold, and that has shares of the company plunging. Musk wants more information about the proportions of fake accounts on the social media platform. In a recent filing, Twitter said that fake accounts make up fewer than 5% of its users. Musk also tweeted that he's still committed to the acquisition. Some European Union nations say it may be time to consider delaying a push to ban Russian oil. The problem is they can't persuade Hungary to back the embargo. By putting the oil ban on hold, the EU could proceed with the rest of a proposed sanctions package. The UK's Chancellor of the Exchequer, Rishi Sunak, says the Brexit settlement in Northern Ireland is causing economic and political harm. On Bloomberg Television, Sunak was asked whether the UK would take action on its own.
No decision has been taken. Our preference has always been to have a negotiated settlement. I know the Foreign Secretary continues to engage with her counterparts in Europe about how we can find resolution to some of the very real challenges that the protocol is causing.
You can get more on that story from our new Bloomberg UK website, your premier destination for business and financial news in Britain. Just go to bloomberg.com/UK. Internet service on US airlines is about to get a lot better. Southwest Airlines will add a second Wi-Fi provider, Viasat, for faster speeds on more than 400 new Boeing 737 MAX jets. Meanwhile, Elon Musk's Starlink satellite system has a couple of clients and has approached 4 of the country's largest airlines. Global news 24 hours a day on air and at Bloomberg Quick Take. This is Bloomberg.
This is Elon Musk being Elon Musk. I don't see it. I don't see him turning back. If he did turn back Twitter, there'd be some sentiment reset. But I think on a fundamental basis, I don't think he actually paid much of a premium. I think that Twitter was not as mispriced as perhaps some other equities have been.
No one on the FANG stocks has been more right and has been less humble like the Bull crew than Barton Crockett, senior research analyst, Rosenblatt Securities. There on Twitter, of course. Thrilled to have Mr. Crockett with us this morning, and particularly his enthusiasm for Alphabet and the others, not so much. With a chart of the moment, Kriti Gupta.
Yeah, Tom, let's talk about the Twitter, the Tesla deal, the Twitter deal that's hitting Tesla. After all, the Elon effect, it's taking a macro swing, which brings me to my chart of the day. We're doing a two-liner today, shaking things up. Twitter and Tesla shares normalize on a percentage basis, going all the way back year to date. And what you'll see is since the deal was announced or even thought about really on Elon Musk's Twitter account, you see this variation. Twitter shares have been relatively stable, of course, kind of being fixed to some extent to that 54.20 offer price. Tesla shares, on the other hand, have taken a dive. And a lot of this is because of concerns that if Elon Musk goes to Twitter, does Tesla suffer because of the lack of attention? Now we know that there is a macro effect because Tesla is, after all, a major heavyweight. So every time Twitter shares go up off the deal news, Tesla shares drop and drag the entire benchmark down. Whether that's your macro take on why you should care about Elon Musk's Twitter deal.
Kriti, thank you so much. Kriti Gupta with us, Lisa Abramowicz and Tom Keene here. And right now, someone with a greater breadth and scope and scale of revenue at Twitter and frankly at other companies as well in tech. Brian Wieser, he is Business Intelligence President at Group N. Brian, I don't want you to give me buy, hold, sell here, but I want you to talk about the revenue hopes that Mr. Musk would have if he looks at Twitter private as a 3-year exercise to go public. What is the kind of revenue or revenue strategy he would take?
Don't really know, right? I mean, it all reminds me of the South Park episode on the underpants gnomes, right? Where get underpants is part A, phase A, phase C is make profit, phase B. We don't know. And that's the problem, right? We don't know how exactly he's going to multiply the user base by 5x, whatever that correct user base was. And so there's always been probably some willful optimism is the word I'd use to describe it.
Does Twitter have scale with or without Musk? You've always been great about having that immovable force called scale. Does Twitter that you perceive have scale?
Enough scale to be a niche platform. And this has been a critique of a lot of, well, the company's analysis of itself from the IPO. They thought they could be Facebook. They thought they could be something universal. They were never more than a niche. There's nothing wrong with that. It's like they shot for the stars and they got to the moon. That's okay. They are big enough to be a very important player. They're really important for communications in general.
Brian, how much is the back and forth and frankly the noise around Elon Musk and Twitter deteriorating value of the company by virtue of morale when it comes to employees, as well as the confidence that people have in the reality of what's being said?
Yeah, it's been really, I think, damaging from a long-term perspective. The good news is that I think for most marketers, we represent many of the world's largest. They want to use Twitter as it is now. The work that Twitter's been doing towards building this brand safer platform has been really useful, really helpful. It's contributed to a lot of extra spending. And so in a sense, the short term, it hasn't had any impact, but it absolutely is on everyone's mind when it comes to any long-term planning.
Right now, we're seeing this whipsaw. The broader indexes that have already been whipsawed dramatically by a complete re-rating in big tech. We were speaking earlier about how perhaps Twitter hadn't participated with some of the upswing and so therefore has less downside. Do you think, though, that in the broader complex, there is that much more downside as people re-rate to a new inflationary environment?
I think that there's, from a business perspective, frankly, it's still growth ahead. I don't see any real consequences from the current economic environment in terms of any negativity on the ad revenue side or the revenue of the business. Stock's a different matter.
Tell us about the trend forward, Brian. You have been great about the persistence, the length of TV. Everybody else has talked death of TV, and you've really pushed against that. What do the next 12 months hold for the revenue grab that is traditional television?
Well, television had a really, really strong first quarter. I mean, possibly up double digits even. It's hard to know with any precision at this moment. Television is going to hang on from a revenue perspective because it's still uniquely powerful, uniquely impactful. There are real problems because cord cutting is a mid-single-digit percentage thing in the United States, and it's happening everywhere around the world. The reality is that more consumption is going to add free or ad-light environments, and what TV stands for is really reach and frequency. Those are the two metrics everyone needs to focus on. Those metrics start to fall apart the more that people are consuming streaming.
Brian, thank you so much. A view of Twitter there, and of course this story through the day on Bloomberg Radio and Bloomberg Television. Mr. Wieser is with Group M. Lisa, your observations on the week, and what do I study over the weekend to get the next week?
How much have we priced in growth fears? How many growth fears should we be pricing in? Have we really seen a shift in terms of how the reaction is going to be for the rate hikes going to lead to slower growth? I mean, that's really my question, because frankly, right now you're seeing bond yields rise, and I'm wondering whether we've washed out all the positions and we're just going to get chop, right? The sort of battle between fears of growth scares as well as rate hikes.
One of the advantages we have, folks, is we have the red and green of the Bloomberg launch pad, which is a big data screen here, in my case, of equities, bonds, currencies, commodities. Lisa just shows bonds. That's all she wants to look at, is bonds. And what I see here, Lisa, is price persistency in oil, in dollar. They just won't give way with sterling, 121. There's certain things that just won't give it up. That really interests me.
I actually think that that's an incredibly good observation.
I did okay
you did
there.
Great
Ferro
there.
wouldn't have liked it.
I think that it's really important to note that there have been just a few havens, and they remain the havens, and the only havens, not bonds, not necessarily even some of those cash funds where people pulled money from them, but oil and the dollar. You know, honestly, to me, that's fascinating. This idea of the dollar being the one standout. And honestly, with oil, I just keep coming back to also the point that you highlighted, that Javier Blas was pointing to as well, which is this is about refined goods. This is about refined product. And gasoline futures reaching new record highs today, I think is going to have meaning going forward.
The VIX is 30.32. Is that a crisis?
Well, okay. Some people say that the VIX accurately reflects the volatility that people are seeing, but not necessarily what people are feeling. I don't know. Honestly, right now, people are in a jumble. What was it that Jim Paulson said? They're getting the heebie-jeebies, and I think that he speaks for a lot of people out in Wall Street.
That's not CFA talk, folks. I looked it up, actually. Heebie-jeebies is from the 1920s. And from cartoon strips back when everyone,
I was expecting you to do like some kind of regression of mentions of heebie-jeebies.
No, it's just some of our guests. I mean, Paulson was brilliant this morning. He was basically saying, have courage and stay in this market. We hope you have courage to stay with us through the morning, including the open coming up on Bloomberg Television with John Ferro. I think Dr. Ilarian's in the building, and I wore my New York Jets bow tie. I don't know if he'll speak to me. Stay with us. This is Bloomberg.